Please like, share, and subscribe. Wishing you happiness and good luck every day.
You ever really think about it? Could you take, say, $10,000 and turn it into $1 million? Not with some crazy scheme or a lottery ticket, but with just one single stock? I know, it sounds like something out of a fairy tale, right? But these stocks, the ones they call 100 baggers, they're absolutely real. We're talking about a stock that gives you $100 back for every single dollar you put in. And today, we're going to go on a quest, not just to see if they exist, but to figure out how you might actually find one. Okay, so here's our game plan. We're going to start with that $1 million dream, what it really means. Then we'll tackle what is, without a doubt, the hardest part, just holding on. After that, we'll dissect the anatomy of a 100-bagger and then see it in action with two incredible case studies, Monster Beverage and Amazon. And we'll wrap it all up with what this means for your own investment journey. All right, let's dive right in. Section 1, the $1 million dream. We're talking about going from $10,000 to a cool million. So here it is, the big question, the one that really captures the imagination. And I gotta tell you, this is not just some fantasy. People have studied this, and they've found hundreds of these stocks over the years. Companies that, if you just bought them and had the nerve to hang on, would have delivered exactly this kind of life-changing return. So yeah, the possibility is very, very real. Now, the term itself, 100-bagger, it was made famous by this almost forgotten investment classic from back in the 70s. It really laid the foundation for this whole way of thinking. You know, everybody knows about Peter Lynch and his 10-baggers, but this just takes it to a whole other level. It's way more ambitious and honestly, way more transformative. The journey we're on today? Well, we're really standing on the shoulders of a giant, a guy named Thomas W. Phelps. He was an analyst and a writer who was the first person to really systematically study these incredible investments. His book from 1972 was a total game changer, and all the modern work we're looking at today, it's a direct descendant of his original groundbreaking ideas. And this right here, this is the absolute heart of Phelps's wisdom. He realized that finding a potential winner, that was only step one. The real test, the thing that separates a cool idea from $1 million payday, is almost all psychological. It's a test of your gut, your temperament, not just how smart you are. Which leads us perfectly to the single biggest obstacle on this whole quest. It's not finding the right stock, it's having the conviction, the sheer guts to not let go. Let's really dig into why that is so ridiculously hard. Let's make this real. This journey is just a gut-wrenching roller coaster. Imagine you buy Berkshire Hathaway back in '72 for $80 a share. 3 years later, you've lost more than half your money. It's down to $38. Every single instinct in your body is screaming, sell, get out now. But that pain, that terrifying drop, that was the price of admission to one of the greatest wealth creation stories in history. So how do you fight those instincts? Well, an investor named Robert Kirby came up with this brilliant mental trick called the coffee can portfolio. The idea comes from the Old West, where people would stash their valuables in a coffee can and bury it. In investing, it means you do your homework, you buy the absolute best businesses you can find, and then you metaphorically lock them away. It's all about protecting your investments from your own worst enemy, you, and that little voice in your head that says you should always be doing something. Of course, the challenge today is that this whole coffee can idea feels kind of crazy, doesn't it? We live in a world that's moving at 1,000 miles an hour. The entire business landscape is changing under our feet, which creates this real tension between the patience you need for the long term and the reality of just how fast things are changing. And that tension, that feeling, it's backed up by the data. Look at this. Back in 1958, the average company on the S&P 500 stuck around for over 60 years. Today, it's less than 20. This constant churn, this creative destruction puts massive pressure on all of us to be more active because a company's edge just doesn't seem to last as long as it used to. Okay, so if holding on is the psychological battle, what is it that we're actually supposed to be holding on to? What does the blueprint for one of these potential giants look like way back at the beginning of its journey? Well, it turns out there are some common traits we can hunt for. The most insane returns, they're almost always powered by what you can call the twin engines. Engine number one is the business itself. It just has to grow its earnings, plain and simple. But engine number two is all about perception. The market has to wake up, recognize that growth, and decide it's willing to pay more for it. When you get both of those engines firing at full throttle at the same time, the results can be absolutely spectacular. One study actually broke these traits down into a really handy 5-part acronym, SQGLP. It starts with S for small size. You need that long runway for growth. Then Q for high quality in the business and its managers, paired with G for high growth and earnings. Now this next one is critical. L for longevity. That quality and growth has to stick around for a long time. And finally, P for a favorable price. You got to get in at a good price. Keep this formula in mind because we're about to see it in the wild. All right, let's see these ideas come to life. We're going to start with Monster Beverage, a company that started out as a little natural soda company and went on to deliver returns that were, well, they were just monstrous. Just look at these numbers. Between 2002 and 2006, you are witnessing a business hitting escape velocity. Yet net sales grew over 6 times, which is amazing. But look at the operating income. It grew 30 times over. This is what happens when a great brand just catches fire. You get massive sales growth, plus your profit margins expand at the same time, and it creates an explosion on the bottom line. This is a perfect picture of the G, that high growth from our formula. And yet, while that financial rocket ship was taking off, here's what some of the smartest folks in the room were saying. This is a real quote from a very respected investor who was betting against the stock in 2005. It just perfectly captures the wall of doubt you would have had to climb. To hold on, you had to ignore a whole choir of smart, sophisticated people telling you that you were a fool for owning an overvalued fad. Okay, our next case study is a giant everybody knows, Amazon. But the secret to its 100-bagger story was seeing the company in a way that justified all the common wisdom, especially that old myth that it never made any money. You know, the entire investment case for Amazon in its early days really boiled down to this one single powerful chart. Back in the early 2000s, e-commerce was just a tiny, tiny sliver of all retail. I mean, even by 2014, it was still less than 10%. The runway for growth wasn't a runway. It was an entire continent of untapped potential that Amazon was perfectly positioned to conquer. So what about that no profits myth? Well, the key was understanding how Jeff Bezos thinks. He didn't see research and development as an expense for today. He saw it as an investment in tomorrow. So if you just look at their reported operating margin, yeah, it looks razor thin. But if you just add back that massive R&D spending, you suddenly see a consistently profitable business with a healthy 10% margin hiding in plain sight. Amazon wasn't unprofitable. It was just reinvesting every penny it could to capture that giant runway we just saw. It was building a business for L, longevity. So we've looked at the theory, we've seen the case studies. What's the big takeaway here? What does the map for this crazy journey actually look like when we put all the pieces together? You know, at the end of the day, the math of a 100-bagger is just, it's undeniable. This isn't about getting lucky on a quick trade. It is all about the slow, relentless, beautiful power of compounding. To turn $1 into 100 means you need a good return over a very long time, like 20% a year for 25 years, or an absolutely insane return over a shorter time, like the 50% a year monster needed to pull it off in a decade. There are absolutely no shortcuts. So, we can boil this whole quest down to 5 core principles. It all starts with buying right, finding those great little companies. You gotta look for those twin engines of earnings growth and market perception. Then comes the hardest part. You have to hold on, using that coffee can mindset to ride out the terrifying storms. This means you gotta think in decades, not quarters, because the really big money is made in the final years. And finally, a huge advantage is to bet on founders, the owner-operators who have their own skin in the game right there alongside you. You know, in the end, this search for 100 baggers, it's not just a formula or an intellectual puzzle. The principles are clear. The examples are there for us to study. The map exists. But just like Thomas Phelps figured out 50 years ago, knowing the path is one thing. Having the conviction, the temperament, and the sheer brutal patience to actually walk it, well, that's the real journey, isn't it? All right, let's get started. Today, we are going on a quest, a really fascinating one if you ask me. We're going to try to uncover one of the most powerful, but honestly often overlooked secrets to building real wealth in the stock market. We're hunting for giants. So what are we actually chasing? The term is a 100-bagger, and all that means is it's an investment that gives you $100 back for every single dollar you put in. It's the grand slam of investing. It's the kind of home run that can literally define your entire financial life. Now, to put that in perspective, Think about it like this. A single $10,000 investment, which is, a real amount of money, not some fantasy number, turns into $1,000,000. This isn't just about getting rich quick. No, it's about life-changing returns from one smart and very, very patient decision. I know what you're probably thinking. This sounds outrageous, right? Almost impossible. It feels like a financial fairy tale, the kind of story you hear about someone's cousin's friend. But what if it's not just a lottery ticket? What if there are actual identifiable patterns that lead to these incredible outcomes? Well, that's exactly what we're going to dig into. My own obsession with this whole idea really kicked into high gear when I stumbled upon the work of this incredible guy, a man named Thomas Phelps. His wisdom on this exact topic is just unbelievable, and his main ideas are so profoundly simple that they almost feel radical in the noisy, complicated world we live in today. And this one quote, just cuts right through all the static of modern finance. The secret isn't some complex algorithm, it's not day trading, it's not frantic activity. Nope. According to Phelps, it comes down to two simple things. First, you make a good decision and buy a great business. And second, you find the incredible patience to just let it work. Phelps had these great kind of old school sayings, and this one perfectly explains a fundamental trap we all fall into. He argued that we, as investors, and definitely Wall Street, we crave activity. We want to see things moving, trades happening, action. It makes us feel like we're in control. But we have to be smart enough to know the difference between just being busy and getting real, tangible results. And this slide, I think, just lays out the core conflict perfectly. On one side, you have the market screaming for short-term action. What did it do this quarter, this week, this hour? But Phelps's wisdom says, forget the noise. True wealth is built by focusing on the business itself. I mean, think about it. Would the founder of a company sell everything just because the stock price dipped for a few months? No way. And we, as investors, should really try to think more like that founder. Now, to really drive this point home, Phelps shared some pretty painful stories. These are cautionary tales about fortunes that were lost, not because of bad investments, but because of selling great investments way, way too early. So first up, Phelps tells the story about his friend, an inventor and industrialist named Carl Pettit. Now, Pettit owned a pretty big chunk of a promising young company you might have heard of, IBM. And he decided to sell his shares for what seemed like a totally logical reason at the time. He needed the cash to fund his own new business. And he made $1 million from that sale. I mean, fantastic, right? No one would argue with that. But that same stake in IBM, if he had just tucked it away and held on, eventually became worth over $2 billion. $2 billion, way more than he ever made in his other business. It was $1 million success that was actually hiding a $1 billion mistake. Then, with this incredible honesty, Phelps shares a story about his own mistake. A blunder so profound that he actually kept the physical confirmation slip from the sale for years, as a constant, painful reminder of the lesson he learned the hard way. This was the amount he needed, $7,415. He sold his stock in this really cool, innovative company called Polaroid to cover a medical expense. A totally practical, responsible decision that, let's be honest, any one of us might have made. And less than 20 years later, that same stock was worth this much, over $800,000. As Phelps himself put it, that was one incredibly expensive doctor's visit. So here's the absolute crucial point, the moral of these stories. Selling a truly great company for a short-term, non-investment reason, whether it's to pay a bill or diversify or even just to lock in a profit, that decision can be one of the most expensive financial mistakes you will ever make. And Phelps uses a simple table like this one to show you the powerful math behind these 100 baggers. It's not magic, it's just two ingredients. First, you need a high rate of growth, of course. But just as important, you need that growth to continue over very, very long periods of time. We're talking decades here, not quarters. This wisdom is so powerful, so timeless. It really made me want to dig deeper into the man himself. I mean, who was this guy, and why on earth hadn't I heard more about these incredible ideas before? So who exactly was this Thomas Phelps? Well, turns out he was the former editor of Barron's, a partner at a big Wall Street firm. I mean, he was no amateur. And yet, His name isn't as famous as Peter Lynch or Warren Buffett. How could such profound wisdom get so overlooked? And this is where I have to make a little confession, a bit of a twist in our story. The way I've been framing this, like a personal journey of discovery through his work, well, the discovery part is absolutely true, but the timeline is a little different. The truth is, Thomas Phelps passed away back in 1992. All of these quotes, these incredible stories, this profound wisdom, it all comes from his forgotten book, published way back in 1972. And you know what? To me, that makes his advice even more powerful. It isn't trendy, it's timeless. It has survived decades of market craziness, bubbles, and crashes. So this discovery set me off on a whole new path. It wasn't just about understanding what Phelps had to say anymore. It was about stress testing his ideas. I had to find out if his principles, which were born in a totally different market era, could still hold up in our modern, high-speed, globalized world. Okay, so Phelps's original study covered the 4 decades from 1932 all the way to 1971. So a modern study was commissioned to pick up where he left off, analyzing the next 5 decades, from 1962 to 2014. This basically brings his powerful work right into the 21st century, so we can see what's changed and, maybe more importantly, what stayed exactly the same. Now, look, it is crucial that we are intellectually honest here. A study like this has its limits. A statistician cleverly compared it to trying to figure out why basketball players are tall by only studying professional basketball players. You're only looking at the winners, right? You're missing everyone who didn't make it. It's a classic case of what they call survivorship bias. But the goal here isn't to create some rigid, statistical formula that guarantees success. That just doesn't exist. Investing is way more art than it is science. The real goal is to find wisdom. It's to uncover the guiding principles and the common threads that are, without a doubt, present in these absolutely extraordinary success stories. And that brings us to the final and, I think, most important takeaway. A question that really reframes the entire challenge of investing. We spend so much time, so much energy on analysis, on research, trying to pick the perfect company at the perfect moment. But what if all of that is only half the battle? What if the defining struggle isn't in the finding, but in the simple and sometimes excruciatingly difficult act of just holding on?
Welcome to The Explainer. Today we're going to talk about something that sounds simple, but is one of the hardest things to do in investing. We're going to explore this powerful concept through a series of true stories, and it all boils down to what I like to call the art of holding on.
So let's just dive right in with a big question. What if you could take $10,000 and turn it into a cool million? Now, I know what you're thinking. That sounds like a lottery win, right? A complete fantasy. But what if this wasn't about some random stroke of luck, but the result of one great investment decision?
Well, there's actually a name for this. It's called a 100 bagger, an investment that multiplies itself 100 times over. And the key takeaway from the source material we're looking at today is that this isn't some secret reserved for Wall Street geniuses. It's something that can be achieved by ordinary people.
So how, right? That's the million-dollar question, literally. What's the secret? Well, we're going to uncover the common threads by looking at the hard-won wisdom of investors who came painfully close, and a few who actually succeeded, maybe even beyond their wildest dreams.
Our first story is a tough one. It's a cautionary tale, a lesson that probably resonates with anyone who's ever sold a stock and then watched it just rocket to the moon without them. It's the agony of selling too early.
Now, what's really interesting about this quote is who it's from. This isn't some beginner making a rookie mistake. This comes from an experienced trader with 30 years under his belt. He realized, after all that time, that the most profitable strategy was the one he'd ignored for decades.
Okay, so here's his story. Back in '92, he made a brilliant call. He saw the massive growth potential in China and bought a company called Potash of Saskatchewan for just $2 a share. He held it for 3 years and hey, he walked away with a 4 or 5 times gain. He must have felt like a genius.
So why on earth did he sell? It's not because his idea was wrong. In fact, the China story was still totally intact. He sold because he got bored. He craved new action and felt like the stock was just treading water. He got impatient.
And this slide right here, this just brilliantly illustrates the staggering opportunity cost of that impatience. His reality was a respectable gain, nothing to sneeze at, but the potential he walked away from was a life-changing 100 times return. He was right. He just didn't wait long enough to be proven really right.
Okay, let's move on to our next story, because this one shows that you don't always need some complex, exciting strategy to win big. Sometimes the biggest fortunes are hiding in plain sight, in the most, well, boring places.
I love this quote. It's from another investor talking about his grandmother back in 1971. He says she couldn't really see all that well, except, that is, when she was checking the stock price for her shares in Esso, which you and I now know as ExxonMobil. For that, her vision was apparently perfect.
And what was her grand, complex strategy? It was about as simple as it gets. Buy the biggest oil company in the world and just keep buying it. That's it. No stress, no drama, no chasing the hot new thing. She wasn't trading, she was just holding.
So let's look at the result of that beautifully simple, boring strategy. Let's say you put just $1 single into Esso back then in 1971. By today, that $1 would have grown to $418, 418 times your money. I mean, that's just incredible, isn't it?
And here's the kicker. That number, that astounding $418, that doesn't even count the dividends. For decades, she would have been collecting those checks, those juicy dividend payments year after year.
So, the crucial point here is that patience pays off. But you know what? Sometimes patience requires real courage. It requires nerves of steel, especially when everyone, and I mean everyone, around you is panicking.
This was a real billboard. Up in Seattle around 1970, the city's largest employer, Boeing, was in absolute freefall. Layoffs were everywhere. The mood was so grim that people literally thought the city was finished.
But one investor looked at this widespread despair, and he didn't see a warning sign. He saw a historic opportunity. He had just made $100,000 from selling some property, and he figured, you know what? It just can't get any worse for Boeing. So he put it all in, bought 10,000 shares, and then he just held on for decades. And his reward for holding on through all that fear? It's almost hard to believe. Within just 10 years, the annual dividends he was getting from Boeing were almost as much as his entire initial investment. He was getting paid back his whole bet over and over again. A true 100-bagger.
But holding on is tested most severely at the extremes. What if you had invested with, say, the world's greatest investor, Warren Buffett? You'd think that would be a pretty smooth ride, wouldn't you? Well, you'd be wrong.
So, imagine it's the end of 1972. You invest in his company, Berkshire Hathaway, at $80 a share. You're feeling great. You're with the master. Then, 3 years go by. You check your statement, and your $80 investment is now worth just $38. You've lost more than half your money.
Now, what's really interesting here is that it wasn't just Buffett. The whole market, the S&P 500, was down about 14%. But look at this. Berkshire Hathaway fell a whopping 53%. It performed almost 4 times worse than the overall market. The temptation to sell, to just get out in disgust, would have been absolutely immense.
And yet, holding on through that terrifying period, through that gut-wrenching drop, was the only way to realize one of the greatest investment returns in all of financial history. That $38 share would eventually be worth over $223,000.
So all of these stories, they really just distill down into 2 simple rules. First, you have to buy right. That's the research part. That's having real conviction in the story. But step 2, hold on. You know, it sounds so easy when you say it, but as we've just seen, it is without a doubt the hardest and most important part of the whole game.
In the end, what we've seen is that phenomenal returns, they aren't about complex trades or being glued to a screen 24/7. They're about overcoming our own impatience, our own fear. The rules are simple, but the execution, that's hard. So the real question isn't just about finding the right investment. It's about whether you have the patience to truly win.
All right, today we're going to dig into an investment strategy that is, honestly, so simple it sounds revolutionary. It's called the coffee can portfolio. And yeah, the whole thing is built on the almost unbelievable power of doing, well, absolutely nothing.
I mean, just let that sink in for a second. We live in a world where you're just bombarded with noise, right? Trade now, react to this news, chase that hot stock. But what if the real secret to building serious long-term wealth was to just buy some really good companies and then just walk away?
I know, it sounds completely nuts,
But stick with me, because the story behind this idea, well, it might just change how you see investing, period. So where in the world did this idea come from? It wasn't cooked up in some high-tech lab or on a chaotic trading floor. Nope. It all started with something much, much simpler: a forgotten coffee can. So the guy who came up with this was a portfolio manager named Robert Kirby way back in 1984. And his idea was just beautifully simple. He said, look, think back to the Old West. What did people do with their valuables? They'd stick them in a coffee can and hide it under the mattress. The idea is exactly the same for your stocks. You pick your most valuable assets, you put them away somewhere safe, and you just leave them alone. The key, of course, is making sure you put the right stuff in that can to begin with. Now, for Kirby, this wasn't just some theory. The real aha moment, the thing that made it all click, came from a real-life story. See, he'd been managing money for this one client for more than 10 years. Then her husband unexpectedly passed away, and she brought his stock portfolio over to Kirby to take a look. And what Kirby found in that portfolio, honestly, it completely blew him away. At first, Kirby probably got a little chuckle out of it. He figured out that the husband had been secretly piggybacking on all his advice. So every single time Kirby recommended a stock for the wife's account, the husband would go out and buy about $5,000 worth of it for himself. But here's the thing. He did it with a twist. A really simple but frankly genius twist. And this is it. This is the whole secret. Kirby, the professional, was doing all the things you're supposed to do, right? He was actively managing the wife's portfolio, selling the losers, trimming the winners, rebalancing everything. The husband? He did absolutely none of that. He only listened to the buy advice. Then he'd take the stock certificate, toss it in his safe deposit box, and just forget about it. He literally never, ever sold a thing. So what happened? What was the result of this, incredible laziness? Well, sure, his portfolio had some duds. A few stocks had dwindled down to just a couple $1,000s. But he also had a few monster winners. And then there was the jaw-dropper. One of his small investments in a company that was then called Holoid, well, that company became Xerox. And that single holding, just that one stock, was now worth $800,000. That's more than his wife's entire portfolio, the one being professionally managed by Kirby. It was just an incredible victory for doing absolutely nothing. And that story right there just perfectly captures the whole idea. The coffee can portfolio isn't just a strategy for picking stocks. It's a strategy to protect you from, well, you. It's designed to save you from your own worst instincts, that constant urge to check your portfolio, the panic that makes you sell when the market drops, the greed that has you chasing some hot tip you heard about. The idea is simple. Find the best businesses you can, companies you really believe in for the long haul, like 10 years. Put them in your metaphorical can, and then you force yourself not to touch it. Okay, so 10 years sounds like a long time to hold on, right? Well, get this. We're about to look at a real-world example that takes this whole do-nothing idea to an insane extreme. We're talking about an 80-year experiment in pure, unadulterated patience. So, picture this. It's 1935, right in the thick of the Great Depression, and this fund gets started, the Voya Corporate Leaders Trust Fund. Its instructions were about as simple as you can get. The managers had to buy stock in 30 of the biggest, most important companies in America. We're talking giants like DuPont, General Electric. And then, that was it. They were literally forbidden from ever picking a new stock or selling an old one. The only way the portfolio could change was if a company went bankrupt or got bought out. I mean, this was the ultimate set-it-and-forget-it fund. And what makes the Voya story so incredible is when you put it side by side with another fund from that time, the Massachusetts Investors Trust, or MIT Fund. Now, both of them started with the same basic buy-and-hold idea. But here's where their paths split. Voya stuck to its guns, rigid rules, low fees, and it crushed it, even beating the S&P 500. The MIT Fund, on the other hand, well, they gave in to that constant temptation to do something. The managers started trading more, the fees started creeping up, and that beautiful, simple idea just got lost in the shuffle. It really goes to show you how powerful and how incredibly rare just being patient can be. All right, so if this strategy is so simple and it clearly works, you gotta ask, why doesn't everybody do it? The answer is, well, it's because the hardest part of investing has nothing to do with charts or numbers. It's all about battling the person staring back at you in the mirror. And hey, if you think this is just a problem for us regular folks, think again. Even the master himself, Warren Buffett, fell into this trap. Get this. He bought shares in Disney back in 1966. He knew it was a fantastic company, but he sold out just a year later. Now, he made a 55% profit, which sounds pretty good, right? But as he said himself, that was one of the costliest sales he ever made. It's impossible to even calculate how many millions or billions he left on the table by being impatient. So why do we sell? Why is it so hard to hold on? Because the ride to the top is never, ever a smooth one. I mean, look at these examples. If you wanted to get the massive, world-changing returns from Apple, you would have had to sit there and watch your investment drop by 80% twice. Can you imagine that? Or Netflix. It dropped by 25% in a single day, 4 different times. And Pfizer? That stock went sideways for years, doing absolutely nothing before it eventually delivered a 141-to-1 return. Sticking it out through that kind of chaos, it is just emotionally brutal. Really, when you boil it all down, the coffee can portfolio is just the grown-up version of that famous marshmallow test. You know the one, right? Where they put a marshmallow in front of a kid and say, you can eat this now, or if you wait, you can have 2 later. For investors, that first marshmallow is the urge to cash in a quick profit, or the relief you feel selling a stock that's been driving you crazy. The temptation is huge. But the real prize, that second marshmallow, the life-changing return, that only goes to the people who have the discipline to just wait. Okay, but let's be real for a second. That's a fair question to ask. A lot of these stories are old. Kirby's story is from the 50s, the VIA fund from the 30s. The world moves a heck of a lot faster now. So does a buy-and-forget strategy even make sense anymore? And yeah, there's some data that should make you pause. Look at this. Back in 1958, if a company was big enough to make it into the S&P 500, you could expect it to stick around for over 60 years. Today, that number is less than 20. I mean, just let that sink in. At the rate we're going, something like 75% of the top companies today will have been replaced by 2027. That's a mind-blowing pace of change, and it definitely suggests that just blindly holding on forever might not be the slam dunk it used to be. And this speed of change isn't the same everywhere. It really depends on the industry. You know, a boring old utility company can pretty much count on its assets being useful for almost 30 years. But look at tech. In the world of information technology, that window slams shut to just over 6.5 years. Now, this doesn't mean the coffee can idea is broken. Not at all. It just means that the first step, picking companies that are built to last, is more important now than it has ever been. So you might be listening to all this and thinking, okay, this is a strategy for a super optimist, someone who just thinks everything is going to go up forever. But here's where it gets really interesting. What if I told you the coffee can is actually the perfect portfolio for a complete pessimist? I want to tell you about a guy named Barton Biggs. He was a legendary investor, and he called himself a catastrophist. This guy was genuinely obsessed with how wealth gets destroyed. He studied disasters, pandemics, World War II, trying to figure out how a family could possibly hold on to their money when the world was falling apart. He was the kind of guy who was always preparing for the worst-case scenario. So, after all that research into absolute chaos and destruction, what did the ultimate pessimist decide was the best way to protect your wealth? You're not going to believe this. He said you should have 75% of your money in stocks. Yeah, stocks. His reasoning was brilliant. He said stocks aren't just little pieces of paper, they are ownership of real things, factories, brands, land. And when things get chaotic, owning real stuff is what saves you. The other 25%? Yeah, that was for having a farm, some gold, canned food, actual apocalypse stuff. But the main takeaway is that even the guy expecting the end of the world believed that owning great businesses was the key to survival. Okay, so we've gone through the theory, we've looked at the history, the psychology behind it all. So let's wrap this up by bringing it all back home. Let's talk about some real stories from real people that show the incredible power of just doing nothing. And these aren't Wall Street legends. These are just regular investors. One person talks about hitting 100 bagger. That's a stock that goes up 100 times what you paid for it. Then there's this other story, just a fantastic example. An investor bought into 10 different risky biotech companies. 9 of them, poof, went to zero, a complete wipeout. But the 10th one? It was a little company called Amgen. And that one winner didn't just cover the losses, it returned 800 times his entire original investment. That's the beautiful, lopsided math of the coffee can. The most you can lose on anyone's stock is what you put in, but there is no limit, absolutely no ceiling on how much a winner can make for you. So that's where we'll leave it. The coffee can portfolio at the end of the day is less about finance and more about psychology. It's built on one simple hard truth, that when it comes to investing, The biggest enemy we'll ever face is ourself, our own fear, our own greed, and more than anything, our own impatience. This strategy is a tool to fight that. So the last thing I want you to think about is this, and be honest with yourself. What has impatience already cost you in your own life? And what might a little bit of doing nothing be worth in your future? All right, let's talk about something that sounds like it's straight out of a financial fairy tale. You know, the kind of investment that completely changes the game. We're going on a quest today, a quest to understand one of investing's most legendary achievements, the 100-bagger. So here's the big question. Can you really turn 10 grand into $1 million with one stock? I mean, it sounds like pure fantasy, doesn't it? Like winning the lottery. But here's the thing. While it is incredibly rare, it's not just a roll of the dice. There's a pattern. And today, we're going to dig into the blueprint for the stocks that have actually done it. This is the name for our holy grail, a 100-bagger. It's pretty straightforward, a stock that goes up 100 times what you paid for it. And to really get our heads around how this happens, we're not just going to look at one person's opinion. We're actually going to pull together the work of several trailblazing analysts to build a sort of master blueprint. Okay, so here's our game plan. We'll start with the how, the twin engines of growth. Then we'll look at the what, a 5-part alchemist's formula. We'll figure out where to look, the best hunting ground. And finally, we'll cover the secret ingredient that goes beyond the numbers. All right, let's dive right in. Section 1. The hunt for 100 baggers. We're going to start by looking at the pioneers who've already mapped out this territory. So, like I said, we're not reinventing the wheel here. We're taking 4 key studies and piecing them together. Think of it like this. Each study gives us a crucial piece of the puzzle, and by the end, we'll have the whole picture. Okay, so first up, the core mechanic, the twin engines of growth. An analyst named Tony dug into this and found that behind all the hype, there are really just 2 fundamental forces that power these massive returns. It's a pretty simple idea, really, but it's absolutely crucial. Engine number 1 is just earnings growth. The company makes more money. Simple enough, but that's not the whole story. Engine number 2 is what really lights the fuse. It's PE multiple expansion. That's just a fancy way of saying that other people, the market, start getting excited and are willing to pay a way higher price for every dollar the company earns. It's this 1-2 punch that creates the magic. Now, to see this in action, let's look at a real-world example, MTY Foods. This table shows its incredible journey. What's wild is that back in 2003, this was a tiny company that nobody cared about. It was practically left for dead. Okay, so look at this. The company's actual earnings, the profits it was making, grew by more than 12 times over 10 years. I mean, that's an absolutely incredible business performance right there. But the stock price went up 100 times. 100. So where did that extra horsepower come from? Well, that was the second engine firing up. The market's perception totally changed. At the beginning, people were only willing to pay a tiny price for its earnings. By the end, they were falling over themselves to pay a huge premium. That's the power of multiple expansion layered on top of real growth. Okay, moving on. The alchemist's formula, the 5 key elements. So we know the how, the twin engines. Now let's look at the what. A study of the Indian market gives us a fantastic 5-part formula. And they came up with this really handy acronym, SQGLP, to remember the 5 key elements. It stands for size is small, quality is high. That's the business and the management. Growth and earnings is high. Longevity, meaning this quality and growth has to last. And finally, the price you pay has to be favorable. It's a fantastic checklist. Now, that L for longevity is a big one, and this chart really drives it home. Let's say you find a company that returns a phenomenal 21% a year. You know how long it takes to become a 100-bagger at that rate? 25 years, a quarter of a century. This really highlights that you need some serious patience. And this quote from the report really sums up their biggest finding. You can analyze numbers all day long, but at the end of it, they concluded that management is the true alchemist. They're the secret ingredient that brings all the other elements together and makes the magic happen. All right, so we know the mechanics and we have a formula. So where do we actually go looking for these things? Let's talk about the hunting ground, small beginnings and patient hands. And another study, this one by Kevin Martelli, really confirms it. The most fertile hunting ground is among the microcaps. So what's a microcap? It's just a really small company, one with a total value under $300 million bucks. And look at this. There are thousands of these small companies out there. It's a huge part of the market. In fact, Martelli's study found that a whopping 68% of these multi-bagger stocks started out under that $300 million mark. And it just makes sense, right? A behemoth like Apple isn't going to grow 100 times from where it is today, but a tiny, innovative company, it has a shot. But here's the catch. It's not just about finding them. You need 3 key virtues. You need the vision to see what others don't. You need the courage to actually buy it when no one else is talking about it. And then, the hardest one of all, you need the patience to hold on to it. Okay, last section. The final ingredient. Beyond the numbers. Because just when you think you've got it all figured out, another study comes along to remind us that it's not that simple. This is such a critical point. The price you pay at the start is everything. You can find an amazing company, but if you overpay for it, you kill your returns. Look at the example. Buying a stock for 5 times its earnings gives you a shot at a 100-bagger. But buying that same exact stock for 50 times earnings, well, maybe you get a 10-bagger. It's a massive, massive difference. And here's another warning. The official earnings number can be really tricky. Heiserman calls these earnings traps. Basically, the reported profit can hide all sorts of things, like how much cash the company is actually spending to get that growth. You really have to dig below the surface to see if the growth is real or if it's just, an accounting trick. And this really gets to the heart of it all. At the end of the day, finding the 100-bagger isn't just about running the numbers. It's not a spreadsheet exercise. It takes something else, something more like vision or imagination. Which brings us back to this incredible quote: vision, courage, and patience. So while the blueprint we've built today, with its twin engines, its 5 elements, its hunting grounds, it gives us a map, it doesn't guarantee we'll find the treasure. Finding a true 100-bagger takes something more. It's about having the vision to see what a small company could one day become. It's not just about analyzing the past, it's about imagining the future.
All right, welcome to The Explainer. Today we are digging into one of the most legendary, almost mythical achievements in all of investing, the 100-bagger. That's the stock that delivers a 100-to-1 return. We're going to break down how it happens, what these companies actually look like, and, maybe most importantly, the kind of mindset you need to find and hold on to one.
So let's just start with the million-dollar question. Literally, is it actually possible to take a pretty modest investment, say 10 grand, and turn it into a cool $1 million? I mean, it sounds like winning the lottery, right? But the source material we're looking at today proves that it is a very real, though, very rare outcome.
Now, the term for this is a 100-bagger, and it was actually coined by the legendary investor Thomas Phelps. And while it might sound like some Wall Street fantasy, it's a real thing that has happened hundreds and hundreds of times. So our goal in this explainer is to really deconstruct what that looks like.
Okay, let's dive into this. Here's our roadmap for today. First, we're just going to establish that these things are real. Then, we'll look at the core blueprint behind them. We're going to explore some real-world examples with a few titans of transformation, talk about the psychological challenge of just holding on, and finally, uncover what might be the ultimate edge for an investor.
Okay, first things first. We need to ground this whole conversation in reality. This isn't just some fun thought experiment. It's a well-documented part of market history. So how common is this phenomenon really?
Well, someone actually did the work. A huge study of the market over 52 years found 365 different companies that hit this incredible milestone. And what's really fascinating is how diverse they are. We're not just talking about little tech startups. The list has everything: railroad companies, retailers, beverage makers, aerospace firms. There is no single industry that has a monopoly on these kinds of returns.
So if it's not about finding a company in some hot industry, then what's the secret sauce? How does any company, whether it makes soda or software, actually deliver a 100-to-1 return? Well, the source material points to a surprisingly simple formula. Now, simple definitely does not mean easy, but it is simple.
It all boils down to what the source calls the twin engines. First, the business itself has to get much, much bigger. We're talking explosive growth in sales. And second, the market's perception of that business has to improve, which means investors are willing to pay a higher price or a higher multiple for those growing sales and earnings. When you get both of those engines firing at the same time, that's when you get that incredible momentum.
Now, what's really interesting here is the third critical ingredient: time. A lot of time. This chart shows that the huge majority of these 100-baggers took between 16 and 30 years to get there. The average journey is 26 years. This is not a get-rich-quick scheme, it is a get-rich-slowly reality. So patience isn't just a virtue here, it's like the price of admission.
And this illustrates perfectly why holding on is so incredibly powerful. So check out this example. You got Mr. Jones and Mr. Smith. They both invest in the same great stock. But Mr. Jones, he sells every year to lock in his gains, and he pays taxes all along the way. Mr. Smith, he just holds on. After 18 years, just by letting his investment compound without getting hit by taxes, Mr. Smith has more than triple the money. That tax drag from trading in and out is a massive wealth killer that most people just completely underestimate.
Okay, so here's a crucial point. A lot of us think that to find one of these stocks, you have to discover some tiny little startup working out of a garage, right? But the data just doesn't back that up. The median company on this list already had $170 million in sales and a market value of $500 million when it started its incredible run. These were already substantial businesses. And maybe even more important, they often didn't look cheap in the traditional sense. You had to be looking forward at their potential, not backward at their past results.
All right, so let's move on from the theory and get into the real world. I mean, theory is one thing, but seeing how actual companies put this blueprint into practice, that's where the lessons really hit home.
First up, a fantastic example, Monster Beverage. They actually achieved a 100-bagger status in under 10 years, which is just lightning fast in this world. Now, this was not an overnight success. The company was originally called Hanson's, and they'd been around forever selling natural sodas and juices. The big transformation, the spark, came when new leadership decided to stop trying to be everything to everybody and instead focus with absolute laser precision on just one thing, building a dominant brand in the brand new explosive energy drink category.
And they didn't just talk about it, they really put their money where their mouth was. Look at this table. In 2001, they had 66 people in sales and marketing. Just 5 years later, that number was almost 600. They'd learned from an earlier failure against Red Bull that you had to spend a ton of money to build a brand, and boy, did they go all in on that strategy.
And the effect on the bottom line was just absolutely staggering. As the brand took off, their profit margins expanded, and their net income just exploded. It went from $3 million in 2002 to almost $98 million just 4 years later. This is a perfect storm of sales growth and margin expansion, a textbook example of those twin engines just firing on all cylinders.
Okay, next up, a name we all know, Amazon. If Monster was about creating a brand in a new category, Amazon was about riding one of the most powerful economic waves of the last century. As you can see here, they became the leader in a market, e-commerce, that went from basically nothing to an absolute behemoth.
And you know what? This was the plan from day one. In his very first shareholder letter, way back in 1997, Jeff Bezos laid it all out. He basically said, look, we are not playing for next quarter's profits. We are playing for long-term market leadership. He knew that total dominance would eventually lead to massive profits, and he has actually included that same letter in every single annual report since then, just to hammer that point home.
So this brings us to a really crucial point. For years, the big knock on Amazon was they don't make any money. But that was only true if you looked at the surface. The source material makes this fascinating argument. What if you treat their huge spending on research and development not as an expense, but as an investment in future growth? When you do that, as this table shows, a totally different picture emerges. Their adjusted operating margin is actually remarkably consistent, right around 10%. The takeaway? They could have shown a profit whenever they wanted to. They just chose to reinvest everything for future dominance.
You know, finding a potential monster or an Amazon is one thing, but the source material is crystal clear that this is only half the battle. The other half, and frankly the harder half, is having the psychological strength, the sheer conviction to just hold on through what is almost guaranteed to be a gut-wrenching ride.
I mean, just look at this journey for an early Amazon investor. In 1999, you felt like a genius. But then, during the dot-com bust, you had to watch your stock completely collapse, by over 80%. The source calls it a soul-crushing decline. You needed an incredible, almost irrational belief in that long-term vision to not sell at the bottom and miss out on the gigantic returns that came later.
And you can't rely on the experts to make you feel better either. Get this quote. This is from a highly respected investor writing about Monster in 2005, calling it a fad business, right before the stock absolutely went into orbit. It just goes to show you the so-called smart money is often dead wrong about these transformative companies because they're judging tomorrow's potential by today's rules.
So all of this,
The twin engines, the incredible patience, the psychological toughness, it all leads us to what might be the single most powerful takeaway from this entire analysis. It's a fundamental shift in how we should probably think about finding that next great investment.
The legendary investor Peter Lynch laid out the math on this perfectly, as you can see here. Just imagine two companies. They both start out earning $1 per share. Company A grows at 20% a year, while Company B grows at a still respectable 10%. Now, the difference seems pretty small at first, but over a decade, the power of compounding just takes over.
After 10 years, the faster-growing company is generating more than double the earnings of the slower one. What that means is that even if you pay a higher starting price for that faster grower, the sheer force of its business compounding is likely going to make it a much better investment over the long run. The rate of growth is the ultimate edge, and it dwarfs concerns about buying something that seems a little expensive today.
So, this whole explainer really leaves us with a final, provocative thought. If the key is to find these great businesses with long runways for growth and then have the patience to hold on, well, what great businesses might we be ignoring right now? What future titans are we dismissing simply because we're too focused on today's price tag instead of the incredible potential of their tomorrow?
All right, let's talk about the holy grail of investing, finding those 100 baggers. You know, the stocks that can turn $10,000 into $1 million. It sounds like a fantasy, right? Like winning the lottery. But what if I told you there's a key, a single, powerful number that acts like a roadmap to these incredible companies? Today, we're going to uncover that secret. So here's what we've got on tap. We're going to start with a financial puzzle that honestly looks like a total scam. Then, we'll reveal the secret metric behind the magic. We'll see how this one idea completely changed Warren Buffett's entire approach to investing. Then, we get practical. How do you hunt for these things? We'll also cover the hardest part, which has nothing to do with numbers and everything to do with your own brain. And we'll wrap it all up with the key to finding your own compounding machine. So, let's kick things off with a little thought experiment from an investor named Jason Donvell. And I want you to put yourself in this situation, because it's the kind of thing that would make your jaw drop, but also make every alarm bell in your head go off. But before we get to that mystery, I want you to just let this sink in. This is a quote from the late, great Charlie Munger. He's saying that if a business is just consistently really good for a long time, you're going to do great, even if you feel like you overpaid at the start. A fine result is probably the biggest understatement in investing history. Keep this idea in the back of your mind. It's the foundation for everything. Okay, so here's the puzzle. Imagine about 15 years ago, you invested in some fund, and these were the returns it posted. Year after year. Just look at that. It's beautiful, but it's also weirdly smooth. Over 20%, then over 30%. It just keeps climbing. No down years, no volatility. It looks fake. I mean, come on. Your first thought has to be, this is a scam, right? Returns this perfect, this steady? That's the signature of a Ponzi scheme. You'd be totally justified in thinking you just found the next Bernie Madoff, who lured people in with returns that were just too good and too consistent to be true. So what is it? Is it genius? Or is it a complete fraud? All right, let's pull back the curtain, because the answer is neither. It isn't a fund and it isn't a scam, but the truth is actually way more powerful, and it points to a secret that can really separate the good investments from the life-changing ones. And here it is, the big reveal. Those numbers, they're not the track record of some hotshot hedge fund manager. They are the year-by-year return on equity figures for a single company, a Canadian consumer finance business called Home Capital Group. See, this wasn't about someone picking stocks. It was the raw performance of just one business. So, what in the world is this return on equity, or ROE? Well, it's actually way simpler than it sounds. It just asks, for every dollar the shareholders have invested in the company, how much profit does the company make? Think about it this way. If you start a little shoe shine stand and you put in $100 of your own money, and after the first year you've made $25 in profit, your return on equity is 25%. Simple as that. It's a pure measure of business profitability. And this is where the rubber meets the road. Look what happened. That boring number, that consistent high return on equity, it translated directly into an absolutely mind-blowing return for the stock's owners. A single share bought for $1.63 in 1998 was worth $80 16 years later. That's a 49 bagger. It turned every $1,000 into $49,000. And here's the thing you have to understand. This is not a coincidence. This is not a lucky break. As Jason Donville says, over a long period of time, the return you get from a stock tends to look a lot like the return the business itself is generating. The stock price eventually has to follow the business performance. It's almost like a law of gravity in investing. Now, this idea of focusing on the underlying quality of the business isn't new. In fact, it's at the heart of a huge, famous shift in the thinking of the greatest investor of our time, Warren Buffett. You really have to think of two different Warren Buffetts. Early in his career, he was Buffett the First. He was a student of Benjamin Graham, and he looked for what he called cigar butts. You know, these ugly, beaten-down companies that you could buy for less than they were worth, get one last free puff of profit out of them, and then throw them away. But then, thanks to Charlie Munger, he evolved into Buffett II. He stopped looking for cheap companies and started looking for great companies, businesses that could grow and compound their value for decades. So how do you spot one of these great Buffett II type companies? What's the secret signal? Well, you guessed it. The key marker, the telltale sign of a wonderful business, is its ability to consistently generate a high return on equity. That became the North Star. It wasn't about finding something cheap anymore. It was about finding something that was truly excellent. Okay, that's the philosophy. It makes perfect sense. But how do you actually do it? How do you go from this idea to actually finding these potential monster stocks? Well, luckily, Jason Donville gives us a super clear 3-step framework. Here it is, the 3-part hunting guide. Step 1, you look for that high ROE, something consistently about 20%. And, this is important, you want it to come from real profits, not from the company just loading up on debt. Step 2, you have to look at the management team. Are they smart about what they do with the profits? And step 3, the business has to actually be growing. Sales have to be going up. You need all 3 legs of the stool. Now let's really drill down on that second point about management, because it is so crucial. It's not enough for a company to be a money machine. The people in charge have to take the cash that machine spits out and put it back to work to keep earning those high returns. If a great business just lets its profits pile up in a bank, earning, 2%, well, that great overall ROE is going to get diluted down to nothing. The magic just fades away. And if you need a perfect example of why that third step, growth, is so critical, just look at IBM for a big stretch of the 2000s. The company had a pretty good ROE, and the stock always looked cheap on paper. But sales just weren't growing. The business itself wasn't getting bigger. And without that top-line growth, the stock just went absolutely nowhere for years. And now we come to it. What I honestly believe is the single hardest part of this entire strategy. You can find the perfect company. You can check all the boxes. But none of it will matter if you can't win the battle that's fought between your own 2 ears. Let's go back to our hero company, Home Capital Group. Even with that beautiful, steady business performance, it was not immune to the madness of the market. During the 2008 financial crisis, the stock price got absolutely hammered. It was cut in half. Can you imagine that? Watching half of your money just disappear on the screen. Just think about that emotional roller coaster. You buy a 98, for 10 years you feel like a genius. Then 2008 hits, and a terrifying crash just wipes out half of your gains. Every fiber of your being is screaming, sell, get out now. But if you had just held on, if you had remembered why you bought it, you would have seen that stock come roaring back to hit $80 a share. The entire 49-bagger return was earned by surviving that one moment of pure terror.
And this question from the author Thomas Phelps just hits the nail on the head. Imagine you tuned out the stock price completely, and the only thing you saw was that original table of smooth, steady, rising ROE numbers. Would you have ever, for a second, thought about selling? Of course not. A business owner would have been thrilled. This is the difference between thinking like a frantic stock trader and thinking like a calm business owner.
Okay, let's put a bow on all of this. We've seen the puzzle, we've found the secret metric, and we've stared into the face of the psychological beast. So now it's time to take all of that and forge the key that unlocks this whole strategy. So if you're going hunting, this is your checklist. This is what you're really looking for. You're looking for a compounding machine, a business that can take its own profits and reinvest them at a super high rate of return for a really, really long time. It helps a lot if the people running the company own a ton of the stock themselves. They have skin in the game. And you want to favor the companies that grow by hitting single after single, not the ones trying to hit a crazy bet the farm home run.
And that's really the big idea here. The search for these life-changing investments isn't about chasing hot tips or trying to find the next random stock that's going to explode. The most predictable path to building real wealth is often the most boring one. Find an incredible, high ROE business, and then have the patience and the stomach to just let it do its thing for years or even decades. So the question I want to leave you with is this: what compounding machine might be hiding right there in plain sight?
Have you ever wondered if there's a simple key to finding great investments? I'm talking about something that has less to do with complicated spreadsheets and way more to do with plain old human nature. It's an idea called skin in the game, and it's all about one simple thing: investing right alongside the people who know a company best, the ones running it. Let's get into it. And look, this isn't some hot new take from a finance blog. The legendary money manager Martin Sosnoff said this, and he put it bluntly decades ago. His point was just brutally simple. If the folks in the corner office, the CEO, the board, don't have a serious chunk of their own money on the line, then you probably shouldn't either. It's a really powerful way to filter out the noise, and as we're going to see, it's more important today than ever. But to really get a feel for this idea, we don't even need a stock chart. Believe it or not, all we need is a classic episode of Seinfeld. It just perfectly and hilariously captures the entire wisdom of this strategy. Okay, you probably remember this one. George gets this hot stock tip. Jerry, of course, he's skeptical. So what's George's big selling point? It's not the company, it's not the earnings. It's one simple fact. An insider, a guy named Wilkinson, has millions of his own dollars tied up in it. That's what convinces Jerry. So what happens? The stock takes a little dip, and Jerry, who has no real conviction, he panics. He sells for a loss. But George, he holds on. Why? Because he's not really betting on the stock. He's betting on Wilkinson. He's trusting the guy who has everything to lose to know what he's doing. And of course, the stock comes roaring back, and George makes a cool $8,000. The lesson couldn't be clearer. Bet on the person who's got the most skin in the game. Now, you might be sitting there thinking, okay, that's just common sense. Align yourself with the owners. But here's what's absolutely fascinating. A huge, multi-trillion-dollar part of the modern market is pretty much designed to completely ignore this idea. And that design flaw, well, it creates this massive blind spot and a huge opportunity for investors who are actually paying attention. The culprit here, if you want to call it that, is the exchange-traded fund, the ETF. Now, these things are incredibly popular, and for good reason. They're basically just simple baskets of stocks that you can buy and sell with one click. But here's the thing you got to understand about how they work. When billions of dollars pour into an ETF, the fund manager has to go out and buy the stocks in that basket almost like a robot, often without any regard for the price. And right there is the crucial flaw. First off, ETF and index creators love liquidity. They need to be able to buy and sell massive amounts of stock without moving the price, so they stick to huge companies. But here's the thing. Companies with big insider ownership, or owner-operators, are naturally less liquid. I mean, if a founder owns, say, 30% of their own company, that's a huge chunk of stock that's just not for sale. So what's the result? The ETFs and the indexes they track either totally ignore these companies, or they give them these tiny, insignificant weightings. And that's where the opportunity is born. You can find these amazing businesses that are just being systematically overlooked by the giant automated river of ETF money. And this isn't just a theory. Check out this real-world example. On the left, you've got Simon Properties, a huge mall operator. It was a massive holding in all of the real estate ETFs, and its stock price was pushed up to a really rich 30 times earnings. And what were the Simon family insiders doing while all this was happening? They were selling, over $1 billion worth, but the ETFs just kept buying. Now on the right, you had a group of other property companies where the insiders had huge personal stakes. They were completely ignored by the ETFs, they traded at half the valuation, and they paid double the dividend. The market was mindlessly rewarding the company where the owners were cashing out, while ignoring the cheaper ones where the owners were all in. It's crazy. And this just perfectly illustrates the entire point. As Peter Doyle from Horizon Kinetics puts it, this whole market dysfunction serves up an incredible deal for the smart investor. Because of this structural blind spot, you actually get the chance to buy what are often better businesses at cheaper prices. So what really makes these businesses better? Why should we go out of our way to find them? Well, it all comes down to the mindset of the person calling the shots. We have to understand the huge difference between a hired professional manager, what we'll call an agent, and a true owner-operator. They are playing two totally different games. This graphic here really captures the whole thing perfectly. On the left, you've got your typical agent-run company, and on the right, the owner-operator model. And as you can see from the arrows, one is a vicious cycle, and the other is a virtuous one. The motivations, the outcomes, they are polar opposites.
So let's start with the agent on the left. For them, it's often all about the compensation package, salary, bonus, options. That makes them hyper-focused on hitting short-term numbers, like quarterly earnings, that make their bonus look good. And this can lead them to do things that look great right now, but might be terrible for the company long-term, like making some flashy empire-building acquisition just to get on a magazine cover. The end result of this whole vicious cycle, often just mediocre returns for the actual owners, the shareholders like you and me.
Now, let's flip that around and look at the right side. The owner-operator lives in a completely different world. Their personal wealth, their family's legacy, it's all directly tied to the long-term value of that stock. They're not thinking about the next 3 months. They're thinking about the next 20 years. They're focused on real, sustainable cash profits. They only make acquisitions when it's a golden opportunity, something that creates real value. And this creates a virtuous feedback loop, driving amazing long-term results for themselves and for every other shareholder right there with them.
Okay, this all sounds really logical, right? It makes sense. But does it actually work in the real world? Does this skin in the game idea translate to better returns? Well, the data is pretty overwhelming, and it points to a very clear yes. Let's look at the proof.
So get this. A study back in 2012 looked at the performance of public companies run by the world's billionaires. I mean, these are the ultimate owner-operators. And what they found was just staggering. These companies beat the broad market index by an average of 7% annually. That is a massive, massive edge. An advantage like that, compounded over time, is the difference between just doing okay and actually building serious wealth.
And that study wasn't a fluke. There's a whole pile of research that backs this up. Way back in 2005, a study found family-controlled companies consistently do better because they focus on the long haul. Then, in 2009, another one discovered that founder CEOs invest more in crucial things like R&D, and they're way better at avoiding those dumb acquisitions we talked about. All the evidence just keeps pointing in the exact same direction. This idea is so powerful, the evidence so clear, that it's been turned into a real investment strategy. Researchers actually built something called the Wealth Index, which is basically a hand-picked collection of these high-quality owner-run companies. And there's even a fund out there designed to copy this index and capture this very specific edge. So how's it done? Well, the proof is in the pudding. Over the last 20 years, and think about what that includes, the dot-com bust, the '08 crisis, the pandemic, this index of owner-operators has beaten the S&P 500 by an average of 2.7% per year. Now, that might not sound as splashy as 7%, but when you compound that edge over 2 decades, it leads to absolutely massive outperformance. It proves this isn't a fluke, it's a real, durable advantage. Okay, so we know that they outperform. The next question is, how? What are these owner-operators, these jockeys we're betting on, actually doing differently that drives these incredible results? Let's pop the hood and take a look. Well, it really comes down to a few key things. First, they are just relentlessly opportunistic. When markets crash and everyone else is panicking, they're the ones deploying cash and buying assets on the cheap. Second, they're super tax efficient. An owner might actually try to make reported profits look smaller to lower the company's tax bill. Now, that can make the stock look expensive to an amateur who doesn't realize the company is an absolute cash machine. And finally, they're strategic chess masters. They don't just own a random collection of businesses, they use them together to create value in ways an outsider would never even see. And this quote right here just nails that first point. The 2008 financial crisis wasn't a time for them to be scared, it was a time of massive opportunity. A hired manager is terrified of what Wall Street will think if they take on debt in a crisis, but an owner-operator, they know that is the exact moment to go on offense, and that's exactly when you want to be invested right alongside them. And if you need any more convincing, just look at this roster. When you think about the most legendary, wealth-creating companies of our lifetime, you'll find an owner-operator right at the center of it. Steve Jobs, Sam Walton, Bill Gates, Howard Schultz, and of course, the master of them all, Warren Buffett. Their vision, their long-term focus, their own money on the line, it was all inseparable from their incredible success. This right here is the blueprint. So here's the bottom line. You can't put this advantage on a spreadsheet. It's not a line item on a balance sheet. But the alignment, the long-term thinking, the passion of an owner, that is a powerful, tangible asset.
It's an intangible edge that is as real as it gets, and it's been the driving force behind decades of incredible performance. So let's bring this all the way back to where we started. Remember Jerry Seinfeld? He was watching the daily price swings, the noise. He got spooked by a little volatility and sold at the absolute worst time. But George, well, he was aligned with the insider, Wilkinson. Wilkinson didn't panic because he had real skin in the game. He knew the long-term value of his company, he held on through the dip, and he cleaned up. And that really leaves us with one final, simple question to ask ourselves about our own investments. When you buy a stock, who are you really giving your money to? Is it a hired hand just managing a career and collecting a paycheck? Or is it an owner-operator, a true partner who only wins when you win? All right, welcome to The Explainer. Today we're digging into something really fascinating, a book by William Thorndike called The Outsiders. And what it does is it basically gives us this incredibly powerful, almost counterintuitive blueprint for spotting the absolute best business leaders on the planet. So let me ask you a question right off the bat. Who's the greatest CEO of all time? I mean, really, think about it. It's a classic debate, right? For a whole generation, though, there was really only one name that came to mind for most people. He pretty much was the definition of a legendary CEO. You got it. We're talking about Jack Welch, Neutron Jack from General Electric. I mean, this guy was a rock star. His time at GE, that was the gold standard. His performance was the yardstick every other CEO was measured against for, gosh, decades. He was the celebrity CEO. And look, the numbers, they're just fantastic. You can't argue with them. Under his watch from 81 to 2001, GE's stock cranked out almost a 21% return every single year. So let's make that real for a second. If you had put just $1 in with Welch on day one, by the time he hung up his hat, you'd have $48. That's more than 3 times better than the market as a whole. That's the stuff legends are made of, right? But is that the whole story? That's what we're here to find out. We're going to challenge that conventional wisdom. So here's the plan. We'll start with that benchmark. Then we'll meet this incredible group called the Outsiders. We'll break down their playbook, see who's running those plays today, and finally, what all this means for you if you're looking for that next killer investment. Okay, so there we have it. Our benchmark is set. Jack Welch at GE, the guy who absolutely crushed the market and became a legend. That's our starting line. Which brings us to the big question, doesn't it? As incredible as that performance was, I mean, turning $1 into 48 is nothing to sneeze at, but was he really the best of all time? While, according to William Thorndike's research, and this is what his whole book, The Outsiders, is about, the answer is not even close. No way. In fact, Welch's amazing record, it doesn't even get him a ticket to the game where the real masters were playing. So who are these guys? Let's meet them. We're about to introduce you to 8 leaders who were, well, completely unconventional. They were quiet, they broke all the rules, and their results? Man, their results make Jack Welch's legendary run look kinda average. Okay, first up, Henry Singleton at a company called Teledyne. This guy was an engineer by trade and just an absolute genius when it came to deciding where to put the company's money. Over his career, every single dollar you gave him turned into, get this, $180. Then there's Tom Murphy over at Capital Cities. He starts with just a couple of small TV and radio stations, and through just pure, raw brilliance, he delivers what investors call a 204-bagger. You know what that means? It means if you'd put 10 grand with him, it would have turned into more than $2 million. Just wow. And then there's John Malone at TCI. This is maybe the most mind-blowing of all. In the wild west of the cable industry, this guy took his investors' money and multiplied it by 900 times. 900x. I mean, that's a number that's almost hard to wrap your head around. So you see the difference here, right? It is just stark. On average, this outsider crew beat the market by 20 times. 20. Their peers, and yeah, that includes guys like Jack Welch, beat it by about 3 times. So we're not talking about them being a little bit better. It's like they were playing a completely different sport on a different planet. So you gotta be asking, what was their secret? How on earth did they do this? And you know what's crazy? It wasn't because they were in some hot new tech industry. Nope. They made these fortunes in everything from boring manufacturing to media, in good times and in bad. The secret wasn't what business they were in. It was all about the tools they used. And it really all comes down to this one idea: capital allocation. Fancy term, but all it means is deciding what to do with the company's money. And for every single one of these CEOs, that was job number one. That was their entire focus. They didn't think of themselves as managers running a company. They thought of themselves as investors managing a portfolio of assets. And check this out. This is what's so cool. This is the entire toolkit. Every CEO in the world has these same 5 options for every dollar of profit they make. That's it. The outsiders weren't geniuses because they invented some secret 6th option. They were geniuses because they were masters at picking the right option at the right time, all with one goal: making each share of stock as valuable as possible over the long run. And what's amazing is they all shared this same fundamental worldview. They were rebels, you know? They completely ignored the noise from Wall Street, all the analysts, all the chatter. They just focused on these core principles. The author, Thorndike, has this great line. He says it's like they were all citizens of a tiny intellectual village, just completely walled off from what all the other CEOs were doing and thinking. Okay, let's make this real. Take Henry Singleton again at Teledyne. He hated paying dividends, hated it. Instead, whenever he thought his own company's stock was on sale, undervalued, he would take all the company's cash and just buy back as much stock as he could. Over his career, he bought back an unbelievable 90% of his own company's shares. Think about that. It's like slicing a pizza into fewer and fewer slices. Each remaining slice just gets bigger and more valuable. Or how about Tom Murphy? He's running Capital Cities, this tiny company that was 16 times smaller than the behemoth CBS. I mean, it's a total David and Goliath story. A rowboat taking on an ocean liner. But Murphy, with his disciplined deals and his laser focus on cash, well, his little rowboat ended up being worth 3 times more than the ocean liner. As the book says, the rowboat won, decisively. Now look, this isn't just some dusty old history lesson. That's the key. This outsider playbook, it's timeless. The exact same principles are being used right now, today, by a new crop of leaders who are creating just staggering amounts of value for their investors. And Thorndike actually points out a few of them. You can see the pattern plain as day. You've got Transdigm, always buying back their stock. NVR, a home builder, has bought back almost half of all its shares. AutoZone, this one's wild. They've bought back 75% of their stock. And then you have a guy like Mark Leonard at Constellation Software, who's basically running this acquisition machine, gobbling up 30 smaller companies in a single year sometimes. So what's the big takeaway here? It's that the pattern works. It's repeatable. It doesn't matter what you're selling. Aerospace parts, houses, software, whatever. The core ideas, being smart with your cash, focusing on cash flow instead of fuzzy accounting numbers, and caring more about per share value than just being the biggest, those ideas work anywhere, anytime. Okay, so we've seen these just unbelievable track records, both from the original outsiders and the new ones. So what does this all mean for you? For someone who's looking for that next great investment, that next potential 100-bagger? Well, what it gives you is a checklist, a blueprint. You stop looking for the slick, charismatic CEO who's always on TV or on the cover of magazines. Instead, you start looking for someone who thinks like an investor, not a manager. Someone who obsesses over cash flow, who isn't afraid to be unconventional with the company's money. And, this is a big one, someone who is an owner themselves, with their own skin in the game right next to yours. And here's the crazy part. Thorndike points out that even today, most of Wall Street still doesn't get this. They're still obsessed with reported earnings and nice, predictable growth. Which leaves us with one final, and I think pretty exciting question to chew on. The last group of outsiders delivered returns that could literally change your life. 100x, 200x, even 900x. So who's out there right now, quietly using this exact same playbook to build the next one? Today, we're going to dig into one of the greatest investment stories ever told. We're talking about Berkshire Hathaway. We are going to pull this thing apart and figure out how they delivered returns that are, well, they're just hard to believe. And we're going to uncover the secret, the structural secret that really made it all happen. This quote from Charlie Munger, it just hits the nail on the head. It's the perfect way to start. Because the usual story you hear about Berkshire, that Warren Buffett is just a stock-picking genius, well, that's true, of course. But it is not the whole truth. The market was wrong about how this company was actually built, and that's where the real magic, the real secret, is hiding. I mean, just to wrap your head around the scale of this, look at these numbers. If you would put 10 grand into Berkshire back in 1965, 50 years later, you'd have $180 million. That's not just a home run, that is a completely different ballgame. An 18,000 bagger. So the question we have to ask is, how is that even possible? Okay, so here's our game plan. We'll start with the mystery itself, then we'll pull back the curtain on the secret ingredient, insurance float. After that, we'll look at the incredible discipline it takes to use it, zoom out to see the bigger holding company model, and then see how people are hunting for the next Berkshire. And finally, we'll boil it all down into a template you can use. All right, let's jump right into this mystery. See, it's not just that the returns were massive, it's that they were so steady for so long. Performance like that, it just defies the normal ups and downs of the market. And that tells you there has to be something else going on here, something deeper than just picking good stocks. So yeah, the popular story is simple. Warren Buffett is a once-in-a-century investor. And look, nobody's arguing with that. But focusing only on his stock picking is kind of like admiring a Formula One driver's skill without ever looking at the engine in their car. There was an incredibly powerful engine driving Berkshire's growth, a structural advantage that most people just completely miss. And that right there brings us to the heart of the matter. The secret ingredient, the engine under the hood, is this beautiful, simple, but incredibly powerful idea from the insurance world. It's called float. So what is this float thing anyway? Well, think about it. When you buy car insurance, you pay your premium right up front. But the insurance company, they might not have to pay a claim on your policy for months, maybe even years. That big pile of cash they're holding in the meantime, that is the float. And here's the kicker. They get to invest that money for themselves. Let's just break it down into 3 simple steps. First, Berkshire's insurance companies, they collect all the premiums from their customers. Step 2, Buffett takes that giant pool of money, the float, and he goes and invests it in stocks, he buys whole companies. And then, step 3, way down the line, they pay out the claims as they come in. And all the profit they make from those investments, that belongs to Berkshire. It's basically a giant interest-free loan from their customers. And listen, this wasn't some small-time strategy. This was enormous. On average, this float gave them leverage equal to almost 40% of their entire capital base. Just think about that. They were using other people's money on a massive scale to pour fuel on their investment fire. And this chart just shows you the insane cost advantage they had. For nearly 50 years, the US government had to pay, on average, over 5% to borrow money. Berkshire, using its float, paid just over 2%. And in a lot of those years, their insurance businesses were so profitable that their cost of capital was actually negative. They were literally getting paid to hold and invest this money. It's this fuel that let them go out and buy huge companies like See's Candies and make these massive, concentrated bets on stocks like Coke and American Express. But, and this is a huge but, this wasn't some magic money machine that ran itself. To get access to this cheap capital, you need a level of business discipline that's, well, it's almost unheard of. It's the discipline to just say no. Just look at this timeline for National Indemnity, one of Berkshire's insurance companies. In 1986, it's writing almost $400 million in premiums. But then, look at what happens. For more than 10 years, that number crashes. Why? Because the insurance market went crazy. Other companies were chasing growth at any cost, cutting prices to ridiculous levels. So what did Berkshire do? They just shrank. They walked away. This quote just sums up the whole philosophy perfectly. They didn't abandon their customers. They just refused to sell insurance at a price they knew was stupid and unprofitable. So customers who wanted a cheaper price just went somewhere else. Can you even imagine a CEO today telling Wall Street, yeah, our plan for the next decade is to shrink our biggest business? It's just unthinkable. But that discipline, that's what kept their float cheap and their business rock solid. So how on earth could they do that? How could they get away with it? Well, this whole insurance float engine was housed inside a bigger structure, a structure that gave Buffett the freedom to be that disciplined. We're talking about the investment holding company. And this is the template, the bigger picture we can all learn from. So what is a holding company? Just think of it like a parent company whose only job is to own other companies. It doesn't really make anything itself. The huge advantages are its flexibility. It can invest in basically anything and what they call permanent capital. Unlike a fund manager, the CEO of a holding company never has to worry about a flood of investors demanding their money back right when the market is crashing. And Berkshire is not some lone wolf here.
This is a powerful structure that a lot of smart people use. You see it with companies like Lucadia, Lowe's, Brookfield Asset Management. For years, these companies have used this exact model to buy up different businesses, move capital around, and just compound wealth at incredible rates. The key is that they think like they're building a business for the long haul, not just trading stocks for the short term.
So, of course, this leads to the big question, right? If this model is so powerful, could there be other, smaller Berkshire Hathaways out there right now? And that gets us into this fascinating hunt for the next generation of great holding companies. And this isn't just a fun little thought experiment. There are dedicated investors out there, guys like Todd Peters, who've pretty much made it their life's work to find these companies. He's actually built a whole database of over 100 companies that fit this mold, and he believes that somewhere in that group are the giants of the next few decades. You know, this idea didn't just appear out of thin air. It has really deep historical roots. Investors like Peters draw their inspiration from these legendary financiers, some going all the way back to the late 1800s. These were the guys who figured out that real, lasting wealth comes from owning and building businesses over decades, not from just jumping in and out of the market.
So, what do these hunters look for? Let's break down their checklist because it's super practical. First, they want a discount to the sum of the parts value. Basically, that just means the stock market is valuing the whole company for less than its individual businesses are worth. It's like a built-in discount. Second, high insider ownership. You want the people running the show to have a ton of their own money in the game. Third, you want an owner-operator. Is this person just a manager collecting a salary, or do they think and act like it's their own family business? And finally, a fortress balance sheet. Super low debt, tons of cash. That gives them the power to survive any storm and to pounce on opportunities when everyone else is scared.
Okay, that brings us to the end here. Let's boil everything we've talked about down to a clear, powerful template. What are the big lessons from Berkshire's incredible story? When you really get down to it, it's this three-part formula. 1, use other people's money. For Berkshire, that was insurance float. 2, make sure that money is cheap, really cheap. Their insane discipline allowed them to borrow for next to nothing. And 3, maybe the hardest part of all, have the guts to walk away from the market when it goes crazy, even if it means you have to shrink for a while. The first 2 build the engine, the third one keeps it from blowing up. Now look, let's be realistic. An 18,000 bagger like Berkshire, that was a perfect storm. It was a singular genius, Warren Buffett, in a unique moment in history. That's probably a once-in-a-civilization kind of thing. But that's not the point. The point is the template underneath it all, the holding company, the low-cost leverage, the extreme discipline. That template, for maybe finding a 100-bagger, a truly life-changing investment, that absolutely exists, and it's repeatable.
And so that leaves us with one last thing to think about. We've seen all the financial mechanics, the cool structures, but beyond all the numbers and strategies, what are the fundamental human qualities? You know, things like patience, discipline, a true long-term mindset. What is it that truly makes a business that's built to last for generations?
Welcome to The Explainer. Today, we're going to dive into a really powerful and, yeah, maybe for some, a pretty controversial idea in investing, and that's the incredible power of concentration. It's really all about saying no to being average and instead betting big on your absolute best ideas.
And you know, who better to get us started than the man himself, Warren Buffett? This quote just perfectly captures the dilemma that every single investor has to wrestle with. Are you building a financial Noah's Ark, just hoping a couple of everything will somehow save you? Or are you out there hunting for lions? So this really lays out the 2 roads you can take. Over here on one side, you've got the Noah's Ark path, right? It's a crowded portfolio, a zoo of stocks, where you own so many different things that you are almost mathematically guaranteed to get an average, kind of mediocre result. But then there's the other path, the concentrated way, a focused hunt for just a few truly great ideas. And that's where the potential for really meaningful, life-changing results lives. That's the billion-dollar question, isn't it? How do the absolute legends of the investing world manage to sidestep this trap of just being average? Well, the answer, and you might find this surprising, it didn't come from Wall Street. It was actually developed inside a legendary physics lab. Okay, so to really understand how to size your bets like a genius, we actually have to go back in time a bit. The year is 1956, and we're about to meet the brilliant guy who actually created a formula for winning. So this is John L. Kelly Jr., and let me tell you, he was not your typical stock picker. He wasn't some hedge fund manager. He was a physicist from Texas, a former Navy pilot,
And he was working at the legendary Bell Labs, the innovation factory that gave us things like the transistor and the laser. He wasn't trying to beat the market. He was trying to solve a very, very specific problem about gambling and information theory.
And this is what he came up with, the Kelly criterion. The formula itself is just so elegant, so simple. F, which is the fraction of your money you should bet, equals your edge divided by your odds. Now, in plain English, your odds are just what the bet pays you if you win. But your edge, that's the secret sauce. That's your advantage. It's the difference between the real probability of something happening and the odds you're being offered. Let's make that a little clearer with an example. All right, let's pretend we're at the racetrack. There's a horse, Big Brown, and you can bet on him at 5-to-1 odds. So for every dollar you put down, you get $5 back if he wins. Simple enough. Our odds equals 5. But here's where it gets interesting. You've got an inside tip, solid information, that tells you Big Brown's true chance of winning is actually 1 in 3, not 1 in 6, which is what those 5-to-1 odds imply. That information, that's your edge. Now, the specific math to calculate the edge can be a little tricky, but in this case, it works out to be 1. So now we've got everything we need for the formula. So you take your edge, which is 1, and you divide it by your odds, which are 5, and the formula spits out 0.2, or 20%. Now, just stop and think about that for a second. This mathematical formula says the optimal thing to do is to bet 1/5 of your entire bankroll on this one single horse race. That's wild, right? And it perfectly illustrates the radical, core idea of the Kelly criterion. Okay, I know. If the math just made your eyes glaze over a bit, don't worry about it. You do not need to memorize the formula. The really crucial thing to get here is the principle behind the math. Kelly's work gives us a solid, logical justification for what the greatest investors seem to do instinctively. When you find a truly fantastic opportunity, you don't just dip your toe in the water. No, you bet big. But, and this is a really, really important but, taking this pure kind of greedy formula and just dropping it into the messy, chaotic real world of investing, well, that comes with some quirks. And those quirks mean we need to make a very practical and I think very wise adjustment. Yeah, the full-on Kelly approach is absolutely not for the faint of heart. Its one and only goal is to grow your money at the fastest possible rate. And with maximum speed, you get maximum gut-wrenching volatility. It's designed to keep you from going completely broke, sure, but it will absolutely let you lose a huge chunk of your money along the way. Just think back to Big Brown. If that horse had lost the race, and remember, there was a 2/3 chance that he would, you would have just watched 20% of your capital vanish. Oof. So this crazy punishing volatility is what leads a lot of the pros to a really simple but powerful adjustment. They use the half Kelly strategy. And the idea is exactly what it sounds like. You figure out what the formula says to bet, and you just cut it in half. So instead of that crazy 20% bet, you'd bet 10%. And that trade-off, it dramatically smooths out the ride. You still get most of the upside, but with a tiny fraction of the terrifying downside. And the benefit of that trade-off is just, it's staggering. Look, you might give up a little bit of potential long-term return, but look at what you get in return for that. This quote says everything. With the full Kelly bet, you have a 1 in 3 chance of losing half your money before you ever double it. 1 in 3. By using half Kelly, you slash those odds all the way down to 1 in 9. I don't know about you, but that sounds like a much better night's sleep. So here it is. Here's the biggest challenge when you try to apply this to the stock market. See, unlike a game of cards or a horse race, the market doesn't just hand you a rule book with the exact odds and your precise edge. You're dealing with an uncertain future. That means you have to estimate. You've got to do your homework, analyze the business, its competition, its managers, and then make a really educated guess about its future. Your edge in investing is your research. And because you are guessing, building in that half Kelly margin of safety isn't just a good idea, it's absolutely essential. All right, so if this is all based on making educated guesses, does anybody actually do this in the real world? Let's take a look at how this theory actually plays out in the portfolios of some of the greatest investors alive today. So you might be sitting there thinking, okay, this is a fascinating little theory, a fun thought experiment. But come on, is it practical? Does anyone on Wall Street really build their portfolios like this, betting so aggressively on just a handful of ideas? And the answer to that is a resounding, definitive yes. I mean, just take a look at this. These are some of the sharpest investors on the planet. You've got Seth Klarman with 93% of his capital in just 10 stocks, Bill Ackman with 40% in just one stock, Allergen. And of course, there's Eddie Lampart's famous and, ultimately tragic bet where he put 55% of his fund into Sears. These are not diversified zoos. These are incredibly focused, high-conviction portfolios. They absolutely live and die by this principle of concentration. Now, let's be real. It's highly doubtful that these managers are sitting there plugging numbers into the edge divided by odds formula. It's much more like this wonderful analogy about the legendary pool player Minnesota Fats. You see, he never studied physics, but he had internalized all of its principles, gravity, momentum, angles, just through thousands of hours of experience. It's the same thing with these investors. They've internalized the principles of risk and reward. It's in their bones. Okay, so this brings us right to the end. And I think this is the most important part of our whole conversation. What does all of this mean for you, for the way you think about your own investments? This right here, this is what unsuccessful or at the very least unspecial investing looks like so much of the time. This is your typical mutual fund holding maybe 100 different stocks. This is the Noah's Ark that Buffett warned us about. It's a zoo where every single position is so tiny that none of them, not even your single best idea, can possibly make a real difference to your bottom line. It's a portfolio built on hope, not conviction. And then you have the alternative. This is what a portfolio looks like when it's built on the principles we've been talking about. It's built on conviction, it's focused, you can understand it, and every single position in there is big enough to make a real, tangible impact on your results. So the takeaway from all this is pretty clear, and really it's a call to action. If you want to have any shot at achieving extraordinary results, you have to find the courage to step away from the herd and its obsession with owning a little bit of everything. Keep your list of investments short. Focus your capital only on your absolute best, most well-researched ideas, because that way when you do find that truly incredible opportunity, it will actually matter. And so we'll end with just one question. A question that gets right to the very heart of this entire explainer. It's a simple question, but I think the answer has profound implications for your financial future, and it's definitely one worth thinking about long after this is over. So take an honest look at your own holdings and just ask yourself, is my portfolio a zoo?
So let me ask you something. What if I told you that one of the most powerful tools in modern finance, the stock buyback, has its roots not in some fancy business school, but in a pretty grim 350-year-old scheme that was literally designed to profit from death? It's a fascinating story, and I promise you, understanding it is going to completely change how you look at the companies you invest in.
Okay, so to really get our heads around this, we're going to follow a pretty wild trail. We'll start in the court of a king who was flat broke. Then we'll see how that strange idea is still alive and kicking today. And most importantly, we'll learn how to tell the good ones from the bad ones. We're going to look at some real companies that totally nailed this, get the rules straight from the master himself, Warren Buffett, and then we'll wrap it all up with a powerful clue for finding those massive long-term winners. Sound good? Let's dive in.
All right, our story kicks off not on Wall Street, but way back in the decadent, cash-strapped court of King Louis XIV of France. And it all starts with a clever Italian banker who had a very unusual idea.
So this brings us right to it. What on earth is a tontine? You know, with a name like that, you'd be forgiven for thinking it's some kind of fancy French pastry. And while it is French, I can promise you it is a whole lot darker than that. Definitely not something you'd want to eat.
But okay, fair question. Why should you, an investor here in the 21st century, care about some obscure 350-year-old financial gimmick? Well, because, as we're about to see, its core logic isn't just alive, it is actively shaping the stock market right at this very moment.
So picture this. It's 1652. King Louis XIV needs a ton of cash for a war, but the royal piggy bank is empty. So he calls in this banker, Lorenzo de' Tonti, who comes up with a plan that is just morbidly brilliant. He basically says, okay, let your citizens invest in a government fund. We'll pay them dividends. But here's the crazy twist. When one of those investors dies, their share is just canceled. Poof, it's gone. That means the exact same pile of money is now split between fewer people. The longer you live, the richer you get, because you're essentially inheriting the shares of the dead.
And let that sink in for a second, because this is the key to the whole thing. The way to win the tontine wasn't to be the smartest investor or the luckiest. It was simply to be the last one standing. As other people dropped out, your slice of the pie just got bigger and bigger and bigger, all without you having to lift a finger.
Just remember that idea. Your ownership grows as other shares get eliminated.
All right, fascinating history lesson, right? But how does this connect to your portfolio? Well, I have a feeling old Lorenzo Tanti would be looking down with a bit of a grin, because his core idea isn't just surviving, it is absolutely thriving in the modern stock market.
And today, it's called the stock buyback. The concept itself is really simple. A company just uses its own cash to buy its own shares right off the open market. And then, just like in Tanti's scheme, those shares are effectively canceled, or as we say today, they're retired. And right here, this is where the connection becomes crystal clear. In the tontine, shareholders die and their shares get canceled. In a buyback, the company buys shares and they get retired. See? The mechanism is a little different, but the result is absolutely identical. The remaining owners, the survivors, see their stake in the company automatically get bigger. It is, quite literally, a modern-day tontine. Now this sounds like an absolutely perfect tool for shareholders, doesn't it? But here's the catch, and trust me, it's a big one. In the real world, this powerful tool is often horribly abused, and for us as investors, it is absolutely crucial that we know how to tell the difference. The true goal, the only goal that actually benefits us long-term owners, is to genuinely shrink the total number of shares. You know, fewer slices of the pie mean each slice gets bigger and more valuable. It's really that simple. But then we look at what actually happens, and things get weird. The 500 biggest companies in the US spent a fortune buying back their own stock. You'd think the share count would have just plummeted, right? Well, instead, it actually went up. How is that even possible? It's simple, really. While the company was buying back shares with one hand, it was printing up mountains of new shares with the other hand to give to executives as compensation. It's like you're furiously bailing water out of a sinking boat while your partner is drilling new holes in the floor. It just makes no sense. But let's not let the bad apple spoil the whole concept, because when this is done right, it is unbelievably powerful. So let's look at two companies that have absolutely mastered the modern tontine and created enormous value for their shareholders along the way. First up, AutoNation. When the legendary investor Eddie Lampert got involved here, the company went on an absolute buyback mission. I mean, they have retired an incredible 65% of their shares. Just think about that for a second. That's like making 2/3 of the company's entire ownership base just vanish, concentrating all that future value for the people who stuck around. And this chart just shows you the beautiful result. Just follow that black line. That's the number of shares outstanding, and it's just going down, down, down. Now look at the gray line. That's the stock price, and it's doing the exact opposite. It's almost a perfect mirror image. As the company shrank the number of ownership slices, the value of each one of those remaining slices just exploded. The stock is up over 500% since they started this. Incredible.
Now, for an even more impressive example of just pure patience and discipline, let's turn to Lowe's Corporation, which is run by the Tisch family, absolute masters of capital allocation.
For 4 decades, that's my whole lifetime, Lowe's has just been relentlessly buying back its own stock. They've erased over 70% of their shares from existence. And the result of that long, patient game? Well, every single dollar somebody invested way back in 1961 is worth around $1,240 today. It's just one of the most incredible testaments you'll ever see to the power of making the pie smaller to make each slice that much bigger.
So, okay, we've seen what a great buyback program looks like after the fact, but how do we spot one as it's happening? Well, for that, we turn to the master himself, Warren Buffett, who has 2 brilliantly simple rules for us.
Buffett's rule is just beautiful in its simplicity. He says 2 things have to be true. Number 1, the company needs to be sitting on a pile of extra cash that it doesn't need for its day-to-day business. And number 2, and this is the absolute key, its stock has to be on sale. It has to be trading for less than the business is actually worth.
And you can just hear the conviction in his voice when he talks about this. He asks basically, what more certain or profitable thing can you do with your money than buy more of your own great business when it's cheap? I mean, his logic is just undeniable. If you own a fantastic business and the market gives you a chance to buy more of it at a huge discount, it is the smartest thing you could possibly do with your capital.
So, we've traveled all the way from a 17th century French court to the desk of Warren Buffett. Now it's time to bring it all home. What does all this mean for you in your search for those truly life-changing investments?
So here's the big takeaway. Think of a shrinking share count not as a guarantee of success, but as a giant flashing signal. It's a clue that tells you to look closer. Find a company that is consistently buying back its stock, especially when its stock is cheap. When you see that combination, that's when it's time to roll up your sleeves and do your homework. Because you may have just found a company with a hidden engine that's going to accelerate your returns for years and years to come. So I'll leave you with this. Think about the companies you own, or the ones you follow. Is there a slow, silent, going private transaction happening right under your nose? By simply holding on, are you becoming a bigger and bigger owner of a better and better business every single day? It's a really powerful question to ask yourself, and finding the answer might just change the way you invest forever.
So how is it that some companies just seem to dominate for decades, while others, well, they just fade away? It really isn't about luck. There's a powerful underlying structure that separates the flashes in the pan from the enduring giants. And today, we're going to pull back the curtain and see exactly what that is.
And who better to explain this than the legendary investor Warren Buffett? He gave us the perfect metaphor, a protective moat around a castle. Just picture it. The castle's the business, and the moat, well, the moat is that special advantage that keeps all the competitors, the marauding armies, from ever getting inside. You see, this advantage, this moat, is the whole ballgame. It's the secret ingredient that allows a company not just to survive, but to truly thrive over the long haul. It lets them reinvest their profits at super high rates and just compound their value year after year after year.
So what do these moats actually look like out in the wild? Well, the author and researcher Pat Dorsey lays out 5 classic types. Let's break down exactly how these impenetrable fortresses are built.
All right, first up, the power of a strong brand. Now, this isn't just about people knowing your name. It's about trust. It's about desire. Just think about Tiffany's. You're not just buying a piece of jewelry, are you? No, you're buying that iconic blue box and everything it stands for. That emotional connection is a heck of a defense.
Now this one's interesting because it's when a company makes it a real pain in the neck for you to leave. Think about your bank. Are they really that much better than the one across the street? Probably not. But the thought of moving your direct deposits, all your automatic payments, it's just a massive hassle. And those high switching costs create this powerful inertia that just locks customers in.
This one is an absolute monster in the digital age. A service with a network effect actually gets more valuable to every single person as more people join. It's kind of like trying to sell the very first telephone. What's the point? But once everybody has one, it's indispensable. This creates this incredible feedback loop where the bigger a platform gets, the stronger its moat becomes.
This one's pretty straightforward but incredibly powerful. If you can consistently sell your stuff for less than anybody else, you have a massive advantage. Walmart is the classic case study, right? Its unbelievable scale and logistics and its purchasing power lets it operate on razor-thin margins that its rivals just can't survive on. That is a very, very difficult moat to attack.
And look, this is a brilliant illustration that size is all relative. It can mean being a global behemoth like Intel, whose manufacturing scale is almost impossible to replicate. But it can also mean just dominating a small, profitable corner of the world, like being the #1 insurer for, say, taxi fleets. If the market is too small to attract the big fish, that dominance is a powerful moat all on its own.
Okay, but here's where it gets really tricky. It is incredibly easy to see a moat where one doesn't actually exist. Some things that look like these durable, amazing advantages are really just temporary mirages in the desert.
For example, a fantastic product is not a moat if your competitors can just copy it. Remember when Chrysler invented the minivan? It was a huge hit, but pretty soon everybody had one, and Chrysler couldn't charge a premium anymore. And even the best CEO in the world can't save a business with fundamentally broken economics. As Buffett famously said, when a manager with a reputation for brilliance meets a business with a reputation for bad economics, it's the reputation of the business that remains intact. And here's maybe the toughest lesson of all. Moats are not permanent. Nothing lasts forever, right? Even the deepest, widest moats can get filled in over time. I mean, think of companies like General Motors or Gateway Computers. They once had these formidable moats that have just vanished. New technology, changing consumer tastes, bad management, they can all erode even the strongest defenses. So, that brings us to the big question, doesn't it? For any of us, as investors or business strategists, is there a way to cut through all the noise? Is there some kind of tangible evidence we can look for that proves a moat is real and actually has staying power? Well, to find the answer, we need to understand this powerful force that is working against every single company out there. Think of it like a kind of financial gravity that is constantly trying to pull a company's performance back down to earth. It's called mean reversion. And in competitive markets,
Making huge profits acts like a giant magnet for competition. Competitors see those profits, they rush in, they innovate, they cut their prices, and all that intense pressure tends to pull those exceptional profits right back down to the industry average.
But the real magic, the true sign of a great business, is finding those rare companies that can somehow resist this pull. They're the ones that can sustain that high performance year after year, decade after decade. They are literally defying financial gravity.
So how do we find them? Well, an analyst named Matthew Berry went on a huge quest to figure this out. He did this extensive but unpublished study where he analyzed 4,000 of the largest companies over a 15-year period, looking for that secret ingredient, the financial signature of a business that could consistently beat mean reversion.
So after all that digging, what did he find? What is the single most reliable sign, the financial fingerprint, if you will, that a company has a real durable moat? The study found that while a lot of metrics, like growth rates and even operating profits, they all eventually reverted back to the average. But one number stood out for its incredible resilience. The single most persistent factor, the one that didn't get pulled down by that financial gravity, was a company's gross profit margin.
So why is this one metric so powerful? Well, think of it this way. Gross margin is simply your revenue minus the direct cost of making your product. That's it. It's the purest measure of the value a company adds, and it shows the premium that customers are willing to pay above and beyond the basic costs. It really is the financial signature of a true competitive advantage.
Okay, this is great information, but how do we actually use this? How can we take this powerful insight and become better moat hunters ourselves out in the real world? This gives us a fantastic framework. In fact, it's almost like a secret formula for finding a potential turnaround. If you see a company that has high and stable gross margins, but its operating margins are low, you might have just found a diamond in the rough. It means their core business, the value they provide, is strong. The problem is likely just bloated overhead or administrative costs, which, believe me, are a lot easier to fix than a fundamentally broken business model. So here's your final takeaway, your moat hunting checklist. It's a simple two-step process. First, you identify the story. Can you clearly see one of those 5 classic moat types? Then, and this is the crucial part, you have to verify that story with the data. You have to find the evidence in the financial statements, specifically high and persistent gross margins compared to their rivals, because the numbers will tell you if the story is real.
And finding these durable companies, it isn't just a nice to have, it's absolutely vital. Because as research from Credit Suisse shows, the business world is a brutal, brutal place. Only about 45% of public companies even survive their first 5 years, and less than half make it to 10. A moat isn't a luxury. For long-term survival, it is a necessity.
So, I want to leave you with this question. Think about a company you admire, one you really think is great. Now, apply this framework. Can you clearly identify its moat? And more importantly, can you see the proof in its gross margins? Answering that question, that's the key that separates a good company from a truly great, long-lasting investment.
All right, let's get right into it. We're on the hunt for 100 baggers. You know, those incredibly rare, life-changing stocks that can return 100 times what you put in. But here's the thing. There's no secret formula for this. It's not about some complex algorithm. It's about getting your head right. It's about cultivating a very specific state of mind. So that's what we're going to do today. We're going to break down the mentation, the mental game you have to play to even have a shot at finding one. So this is really the whole ball game right here. The journey to these kinds of returns is first and foremost psychological. You know, it's actually less about what you're looking for and way more about what you learn to ignore. It's about being able to filter out all the noise, the day-to-day market chatter, what the Fed's going to do, the talking heads on TV yelling at you. All of that, it's just a distraction. You know, real success in this game, it doesn't come from being busy. It's not about constant trading or chasing the latest hot stock tip. It actually comes from the exact opposite. It's about inaction. It's about patience. It's about having the mental discipline that just plant your feet and stand still while everyone else is running around like their hair's on fire. So here's our game plan for building this mindset. We're going to tackle 5 key areas. First up, why you absolutely cannot chase returns. Second, we'll talk about the silent portfolio killer, and that's boredom. Third, we're going to look at how you can build a defense against scams and fraud. Fourth, why you've got to learn to completely tune out the entire forecasting industry. And then finally, we'll switch gears from all the don'ts and focus on the simple, powerful things that you should do. Okay, first things first, don't chase returns. Now, this is probably the single biggest mistake investors make. It's that natural instinct to run towards whatever's hot, right? To jump on the bandwagon that's already flying down the highway. But as you're about to see, that is a guaranteed way to absolutely crush your long-term results. Just look at this number. It kind of shows you how pointless all that chasing really is. In 2014, which was a terrible year for professional stock pickers, fewer than 20% of them actually beat the market. I mean, think about that. These are the pros, the people paid big bucks to do this with huge teams and fancy computers, and the vast majority of them failed. So if they can't do it, what makes us think we can win by chasing last year's hot stock? And this right here, this shows you the real-world cost of that chasing behavior. There's a famous study from a company called Dalbar that found this huge gap. Over the time they studied, the average fund returned almost 14% a year. Pretty good, right? But the average person investing in those exact same funds, they only made 7%. So where did the other half go? It disappeared because investors pull their money out after a fund has a bad year, and then they pile back in after it's already had a great run. They're constantly and perfectly buying high and selling low. They're sabotaging themselves. And this quote from the investor Monish Pabrai, man, this just sums up the whole mindset perfectly. Someone asked him about underperforming the market for, a 10-month period, and this was his answer. He just sees it for what it is, completely meaningless noise. The media demands we have an opinion on every little market blip, but the truth is there's nothing intelligent to say about it. The road to a 100-bagger is a long, long road, and short-term performance is nothing but an expensive distraction. All right, on to our next mental hurdle. And this one isn't about a market crash or a recession. This is an enemy that comes from within. It's something way more sneaky and, honestly, surprisingly destructive. Just plain old boredom. Now, this quote, it's meant to be a little shocking, right? People are dying of boredom. It sounds dramatic, but it's a powerful motivator. In our modern lives, boredom can feel like a disease. And when it comes to your money, this deep need for something to happen, for some action, can be incredibly dangerous. And this is exactly what happens. We get bored with our portfolio just sitting there, doing its thing. So we do dumb stuff. We start tinkering. We chase some speculative penny stock we heard about, or we pile into some hyped-up company just for the thrill of it. It's really no different than going to a casino. We're craving that excitement, and in the process, we just blow up our own well-thought-out plans. All because we couldn't handle the quiet. But here's the opportunity in all this. The legendary money manager Ralph Wenger figured out what he called a boredom arbitrage. See, the market makes you pay what he calls an entertainment tax for exciting stories. Those hot tech stocks, the revolutionary new companies. They trade at a premium because they're exciting. And the flip side is that boring, dull, unsexy companies often sell at a discount. If you can resist that urge for entertainment and learn to love the boring stuff, that's where you can often find incredible value. And trust me, 100-fold return is anything but boring. Okay, so we've talked about the enemies in our own heads, chasing performance and fighting boredom. Now let's turn our gaze outward to external threats. Because let's be honest, there are a lot of people out there who would be more than happy to pick your pockets if you're not careful. It's time to build a defense. The famous short seller, Carson Block, lays out this whole ecosystem that can be stacked against you, the little guy. It's not just one bad actor. You've got management who's only thinking about their next bonus, boards who are way too friendly with the CEO, lawyers who get paid to write things nobody can understand, auditors who are paid by the very company they're supposed to be checking up on, and investment banks whose job is to sell you stuff, not give you the unvarnished truth. You have to approach the whole system with a healthy dose of skepticism. Let me give you a perfect real-world example. This is an actual disclosure written by the auditor Ernst & Young for a company called Sino-Forest, which turned out to be a complete and total fraud. Just try to read that sentence. Can you make any sense of it? Of course not. It's designed to be confusing. It's designed to make your eyes glaze over. And that, right there, is a massive red flag. And here's the punchline. Carson Block took that entire paragraph of corporate gobbledygook and translated it into 5 simple words. The company never collected the cash. For 16 years, more than 95% of the profit this company reported was basically phantom profit. It never hit the bank account. The lesson here is so simple. If you read something and you can't understand it, the problem probably isn't you. Confusion is a weapon used by crooks. Run away from it. Okay, let's move on to our next big don't. We're just drowning in predictions, aren't we? Where's the market headed? What's the economy going to do next quarter? What are interest rates going to be? There's a whole industry built on this stuff, but for the serious investor, the one hunting for 100 baggers, it is an expensive and ultimately completely useless distraction.
This chart tells the whole story. The jagged, messy black line, that's what actually happened in the economy. See those huge drops, those sharp recoveries? That's reality. Now look at that smooth, calm gray line. That's the consensus forecast from all the experts. You notice something? They never, ever predict the extremes. They always just predict more of the same, a boring middle ground. But the problem is, all the risk and all the reward lives out in those extremes that they always miss.
The investor Howard Marks created this brilliant little chart that shows why forecasting is such a loser's game. Look at that top row. If you just repeat the consensus forecast, what everyone already believes, and you happen to be right, you get an average result. Big deal. And if you're wrong, you still get an average result. It's safe, but you're never going to do anything special. The only way to get those amazing, above-average results is to be in that bottom left box. You have to believe something different from everyone else, and you have to be right. And that is incredibly hard to do over and over again. And if you need any more convincing, just listen to Warren Buffett. He points out that history isn't some predictable line. It's a series of massive, world-changing surprises that nobody saw coming. The fall of the Soviet Union, the stock market crash of '87, these huge events shape our world, but they never show up in anybody's forecast. So instead of trying to guess the unknowable, we should focus on what we can know, the details of a specific business. Okay, so we've spent a lot of time on what not to do. Don't chase returns, don't get bored, don't get scammed, don't listen to the forecasters. And that's half the battle right there, just clearing away the junk. But now, let's get constructive. Let's finish up with a framework for what you should actually be doing. All right, here are 4 core principles for the investor's craft. Number 1, Sosnoff's Law. The best ideas are the simplest ones. Complexity usually just hides problems. If you need a file an inch thick just to understand a company, it's probably a bad idea. Second, have no fixed ideas. Being dogmatic is a killer. The world changes, and a great company can turn into a terrible one. You have to be ready, even eager, to change your mind when the facts change. Third, distrust big, abstract theories. Grand ideas like the Chinese century or peak oil. They're just distractions. Real investing is about specifics, understanding one company in one industry really, really well. And fourth, always remember this is a people business. The numbers on a page don't tell you everything. The best insights often come from talking to people, customers, ex-employees, competitors, who can tell you the real story. And that first lesson about simplicity, well, this is one of my all-time favorite quotes, because nobody said it better than Peter Lynch. He's basically saying that if an investment is so complicated you can't explain it in simple terms, so simple a kid could get it, then you probably have no business owning it. Simplicity, more often than not, is a sign that you're on the right track. So when you boil it all down, the path to finding these incredible investments isn't about adding more information or more complexity. It's a subtractive process. It's about building a mindset that helps you systematically ignore the distractions, the con artists, the noise, and even your own boredom. The whole point is to clear away all that clutter so you can focus on the very few things that actually matter. So that brings us to the final question, a question for you. What noise are you going to commit to ignoring starting today?
All right, let's talk about something every investor thinks about, but, really hopes they never have to live through, a truly catastrophic market crash. We're going to go back in time and look at the ultimate stress test, the Great Depression, to figure out what the absolute worst-case scenario in modern history can teach us about surviving and maybe even thriving during the next one.
So let's start with a little thought experiment. Just imagine it. The market is in an absolute free fall. You look at your portfolio and it's just bleeding red everywhere. What's that first immediate gut punch feeling you have?
Yeah, that's it. It's fear. It's pure panic. It's that little voice in the back of your head screaming, "Sell it all, get out now." We saw it back in 2008, right? And look, it's a completely normal human reaction. But as history shows us time and time again, acting on that feeling is almost always the worst possible move you can make.
So here's how we're going to break this down. First, we're going to tackle that fear head-on and look at crashes as a kind of hidden opportunity. Then, we have to face the music and see just how devastating the Great Depression really was. After that, we'll dive into the incredible story of the famous economist John Maynard Keynes, and then hear from a few other survivors of that era.
And finally, we'll put it all together to build a practical playbook for you for when that next crash inevitably hits.
Okay, so let's jump into section 1, fear, crashes, and opportunity. The big idea here is that even when it looks like the world is ending, the seeds of incredible fortunes are being planted for the very few people who can see past all the chaos.
I love this quote from Thomas Phelps. Bear market smoke gets in one's eyes. It's the perfect metaphor. When things are going badly, that fear, that smoke, it just clouds our vision. It stops us from even looking for good investments right at the exact moment when everything's on sale. But as we're about to see, the biggest economic disaster in history proves just how big of a mistake that is.
Which brings us to our main event, the Great Depression. And I want you to think of this not just as some dusty historical event, but as the ultimate pressure test. Seriously, if an investment strategy could actually work back then, it can probably get you through just about anything.
Just take a second and look at the absolute carnage here. This wasn't some 20 or 30% dip we see every few years. This was a wipeout. General Electric. It went from $403 a share all the way down to $8.50. And look at Warner Brothers Pictures. From nearly $65 down to 50 cents. Can you even imagine? This was the complete and utter annihilation of wealth for anyone who gave into panic and sold near the bottom. And you've got to remember, this wasn't just numbers on a screen. By 1932, 1 out of every 4 working Americans was unemployed. The real-world pain was just immense. And it's against this backdrop of total crushing despair that the stories of the investors who actually made it through, well, they become truly remarkable.
So, this brings us to our main character today, John Maynard Keynes. Now, you've probably heard of him, world-famous economist, right? But today, we're not talking about Keynes the economist. We're talking about Keynes the investor, a man who was almost completely bankrupted by the crash and in the process learned one of the most important lessons in the history of finance.
Just let this quote from 1938 really sink in. He's saying he feels no shame if he still owns stocks when the market hits rock bottom. Think about that. It's the absolute polar opposite of that panic sell instinct we all have. This is a philosophy that was born from tremendous financial pain, and it ended up making him a fortune.
And this chart just lays out his transformation perfectly. It's like night and day. Before the crash, Keynes was a classic speculator. He was trying to time the market, trading in and out, and he lost more than 80% of his net worth. He got crushed. After the crash, he had this huge conversion. He stopped trying to guess what the market was going to do tomorrow and started focusing on the real, long-term value of businesses, and then just held on to them. The result? He personally built a fortune that would be worth around $30 million today.
And if you want proof, look no further. This chart shows the performance of a fund he managed for Cambridge University. From 1931 to 1945, a period that covers the rest of the Great Depression and all of World War II, his fund grew tenfold, 10 times his money. And in that same period, the broader UK market went absolutely nowhere. It was a spectacular performance in the worst environment imaginable.
So what was the secret sauce? How did he do it? Well, it really boiled down to 3 core ideas. Number 1, careful selection. Buy just a handful of investments that you think are genuinely cheap based on their long-term potential. Number 2, steadfast holding. Once you buy them, you hold them through everything, the good, the bad, the ugly, for years if you have to. And number 3, have a balanced position. Own different kinds of risks so that one bad bet doesn't sink your entire ship.
And you can see this wasn't just talk. His actual behavior changed completely. In the 1920s, when he was a speculator, his portfolio turnover was 55%. He was constantly trading. By the 1940s, after his conversion, it was down to just 14%. He learned that patience really is a virtue in investing.
Now, Keynes wasn't some lone genius who figured this all out by himself. This hard-won wisdom was part of a larger set of lessons that were being discovered by anyone who managed to survive the financial abyss of the 1930s.
Take this guy, Floyd Odlum. In the summer of 1933, I mean, picture it, the world is an economic wasteland. He walks into his office and says this. He was known as a salvage artist. Where everyone else saw only ruin and despair, he saw the single greatest money-making opportunity of his lifetime.
So what was Odlum's brilliant strategy? It was actually beautifully simple, and it all came down to one thing. He had cash when nobody else did. He'd sold most of his holdings before the crash, so he was sitting on a pile of $14 million. And he used that cash to buy up entire investment companies that were trading for less than the value of the cash in stocks they already owned.
He'd buy the company, sell off all its assets, and just pocket the difference. It was an amazing strategy that was only possible because he had dry powder. Cash was truly king.
Another survivor, a trader named David Feldman, basically boiled down his entire experience into what you could call Feldman's Law. The key takeaway wasn't just about buying something cheap. The real key was buying something that was going to survive. Thousands of businesses went bankrupt. The most important skill was being able to find the companies with strong balance sheets that could actually make it to the other side.
And that brings us to the ultimate cautionary tale about survival. This is a warning from a 93-year-old businessman to a young and, frankly, pretty arrogant Benjamin Graham. Yes, that Benjamin Graham, the guy who taught Warren Buffett. Graham was using tons of borrowed money to buy stocks, and this old man, John Dix, tried to warn him off.
Well, Graham didn't listen. And in 1930, he paid a brutal price. His fund lost a staggering 50%, way, way worse than the overall market. And why? Because of debt, because of leverage. Using borrowed money is a double-edged sword. It juices your returns on the way up, but it absolutely crushes you on the way down. It's the one thing that can actually force you to sell at the absolute worst time, destroying your ability to hold on. Graham later said that simply keeping the fund from going bankrupt was his greatest achievement.
Okay, let's pull this all together. We've walked through the absolute fire of the Great Depression. So now, let's take all those hard-earned lessons and forge them into a real, actionable playbook that you can use today.
Here it is. This is your playbook, with rules forged in the depths of the worst crash in history. Number 1, focus on the business value, not the market's mood. 2, hold on. Like Keynes, find great companies and be prepared to stick with them. 3, avoid dangerous debt. Graham learned that the hard way. It's the one thing that can take you out of the game. 4, always keep some cash on hand. Be like Odlum, ready to pounce on the opportunities that other people's panic creates. 5, be a contrarian. Trust your own work and have the courage to buy when everyone else is selling. And finally, number 6, just accept that big market swings are part of the game. They're not a signal to run for the hills, they're just an experience to be lived through.
You know, when you really boil it down, the greatest lesson from the Great Depression is a total shift in mindset. A market crash isn't just something scary you have to survive, it's the very event that creates the once-in-a-generation bargains that build incredible long-term wealth. Bad times really are a good fortune in disguise.
Look, the experiences of Keynes, Odlum, Graham, they've given us a clear, proven roadmap. History has already done the hard work for us. So the only real question left is, when the next big crash comes, and it will come, and that bear market smoke gets in your eyes, are you going to have the courage to remember these lessons and actually act on them?
All right, let's get right into it. Today, we are on a quest for the holy grail of investing, the 100 bagger. We're talking about finding those rare stocks that can turn every dollar you put in into 100. Now, I know it sounds like a fantasy, but it is absolutely a real thing, and we're going to distill the essential principles right here, right now. Just take a second and really let that question sink in. What would it actually take to turn $10,000 into $1 million? This isn't about hitting the lottery or some crazy speculative bet. No. This is about an actual process, something you can understand and repeat for finding the world's most incredible businesses. And then, this is the hard part, having the patience to just let them do their thing. So to find the real answers, we've got to get away from all the noise and the chaos of Wall Street. Our journey actually takes us out to the quiet, beautiful horse country of Virginia. We're heading past these amazing wineries and old stone fences to a tiny little town called Middleburg, because that's where one of the greatest and maybe most underrated investors of our time has set up shop. And here, in a refurbished old tavern of all places, we find our guy, Charles Chuck Acre. Now, Chuck's been in the game since 1968, and his track record is, well, it's just off the charts. To put this in perspective for you, if you'd invested $1 in the S&P 500, you'd have about $5.50 today. Not bad. But if you'd given that same dollar to Chuck, you'd have almost 20. He's the kind of quiet master you seek out when you want the real, unvarnished truth about long-term success. And listen, for Chuck Acre, this isn't some academic theory. The man has lived it. He bought shares of Berkshire Hathaway back in 1977 for $120 a share. Today, each of those shares is worth 1,750 times what he paid. Think about that. He also found American Tower when it was just 80 cents a share, and it's since grown into a massive position for him worth over $90 a share.
These aren't just 100 baggers. These are the kinds of wins that an entire career is built on.
So, what's the secret? What's the magic formula? Well, after a whole lifetime of investing, of studying thousands of businesses, and riding out some crazy markets, Chuck Akers has boiled his entire philosophy down. He's cut through all the complexity, all the noise, and he's focused on the one single, absolutely critical ingredient that powers these monster returns. He calls it the reinvestment engine.
Okay, so here's the core idea. You are looking for a very, very special type of company. It's not just a business that makes a lot of money today. The key is finding one that has a place to put those profits to work, to reinvest them back into the business and earn those same incredible returns on a pile of money that's getting bigger and bigger every single year. It's like a snowball of wealth creation rolling downhill. Let's make this crystal clear. Stick with me here. Imagine a great little business, and it starts out with just $100 in capital. And because it's a great business, in its first year, it earns a fantastic 20% return. So it makes $20 in profit. Simple enough, right? But the real magic isn't in that first $20. It's all about what happens next. So instead of the owner pulling that $20 profit out and spending it, the business keeps it. It reinvests it right back into operations. So now the company doesn't have $100 to work with anymore. It's got $120. The engine just got a little bit bigger. The process is officially underway. So in year 2, the business does its thing again, earns that same fantastic 20% return. But this time, it's earning 20% on the new, larger base of $120. That's $24 in profit, bringing the total to $144. Do you see what's happening? It's that classic compounding effect. You're not just earning returns on your money anymore, you're earning returns on your returns. And if this company can just keep this process going, well, this is where the numbers start to get absolutely staggering. After 10 years, that initial $100 is now over $600. That's a 6-bagger. But give it 25 years, and that relentless 20% reinvestment turns your initial stake into a 100-bagger. From $100 to $10,000. It's almost hard to wrap your head around, but the math doesn't lie.
You know, the investing legend Charlie Munger, Warren Buffett's partner, he nailed this idea perfectly. He said, over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. What he's saying is, look, if the business itself is a machine for compounding money at a high rate, sooner or later the stock price has no choice but to follow along. And this slide right here is the perfect picture of what Munger was talking about. Just look at this chart. That lower line, that's a decent business, earning 6% on its capital. It grows, sure, but now look at that upper line, a business earning 18%. It doesn't just go up. It curves, getting steeper and steeper. After 20 years, it's not just a little bigger. The pile of money is nearly 8 times larger. This is why finding those high-return businesses is everything. It's the whole game.
Okay, so if that reinvestment engine is the heart of the 100-bagger, what about the other parts? I mean, a great engine needs a great car built around it, right? Finding these kinds of companies takes a very specific checklist, a clear set of rules. So let's break down that framework right now.
So here's the blueprint, the quick version. First, you have to hunt for elephants. You're looking for the really big opportunities. Then you need the twin engines firing on all cylinders. That's business growth and a good starting price. You have to insist on an economic moat, which is just a fancy way of saying a strong, durable competitive advantage. It's also better to prefer smaller companies because, well, it's easier for a small company to get huge than for a huge company to get even bigger. And finally, you want to seek out owner-operators, people running the business who have their own money on the line, just like you. The first rule is all about focus. As an investor, you've only got so much time, so much brain power. You just can't afford to waste it on ideas that might go up 30% or 50%. You have to be deliberately searching for the elephants, those rare businesses that have the potential for truly massive, game-changing growth. As the saying goes, don't waste your bullets on rabbits when you're out there hunting for giants. Next up, you need this 1-2 punch working for you, what we call the twin engines. The first engine is that the business itself is growing its profits like a weed. The second engine is that you buy it at a fair price, a low multiple. The real magic happens when both engines fire up at the same time. The earnings are exploding, and other investors start to notice and are willing to pay a higher and higher price for those earnings. That's called multiple expansion, and it's like pouring gasoline on a fire. I absolutely love this analogy for thinking about reinvestment.
When you buy a cow for milk, don't plan to race her against your neighbor's horse. See, a company that pays out its profits as dividends, that's your milk cow. It gives you a steady income stream. But a company that keeps every penny and reinvests it at a high rate, that's the racehorse. It's built for one thing: pure, explosive growth. If you want a 100-bagger, you better be looking for the racehorses.
This is such a critical point, and so many people miss it. Every single time you buy a share of stock, it's because someone, somewhere, decided to sell it. So why should you be the smart one in that transaction? Well, the best way to get an edge is to stop thinking like a trader and start thinking like a business partner. When you invest in a company that's still run by the founder, someone whose reputation and personal fortune are on the line, your interests are perfectly aligned. What's good for them is good for you. Okay, so let's say you've done it. You've found a potential elephant. It's got the reinvestment engine, it's got a protective moat, it's run by a genius founder. The hard work is done, right? Not even close. Now comes the part that is, arguably, the hardest part of this whole thing: mastering your own brain so you can actually hold on long enough to see the payoff.
To beat our own worst enemy, our impatience, our fear, our constant need to do something, we need a tool. And the coffee can portfolio is the perfect one. The idea is so simple. 1, you pick your absolute best, most convicted, long-term ideas. 2, you put them in a separate portfolio and, metaphorically lock them in a coffee can. And 3, the most important step, you promise not to touch it or even look at it for at least 10 years. It's a system to protect yourself from yourself.
In this slide right here, this is exactly why that coffee can idea is so important. This is a real-life 100-bagger, monster beverage, a true home run. It turned 10 grand into $1 million. But look at the journey. Look at that second bar. Along the way, it had a single month where the stock dropped 40%. 40. Now be honest with yourself. How many people have the guts to hold on through that kind of terrifying drop without some kind of system forcing them to be patient? The answer is almost nobody.
The investing giant Phil Fisher said it best. He basically said that if you've done your homework right at the beginning, if you have truly found one of these incredible compounding machines, then the question of when to sell gets really, really simple. The answer is almost never. Your job is to find the right business and then get out of the way. So this brings us all the way to the end, to the final, distilled piece of wisdom from this whole process. After all the research, all the numbers, all the psychological battles we've talked about, it really just comes down to a simple 2-part mantra. Buy right. That's all the heavy lifting you do up front. The research, finding that great reinvestment engine, the moat, the owner-operator, and buying it at a fair price. And then, sit tight. And that's the mental game. That's having the conviction, the discipline, and the sheer patience to let the awesome power of compounding do its life-changing work over years and decades. So, we've laid out the treasure map for you. The principles are clear, they're timeless, and they've been proven to work. The only question left is, what are you going to do with it? Now that you know what to look for, what's the first elephant you're going to start hunting for? Thanks for joining me for this explainer.